Okay, let's now proceed to this chapter, which is on performance measurement and evaluation. Okay, from an exam point of view, I think this would carry the maximum weightage. Multiple attempts questions have been tested from this area. On an average, I can expect 20 marks of questioning from this area. Now, let me first give a broad overview of the chapter. See, what you are going to learn here is one, the first thing you are going to learn is different types of organization structure which are there. See, I have a small business, the owner himself will take care of everything. Then we started getting into a bigger company, then we got into something called as decentralization. So all those came in. So you will learn about different organization structure. Based on different organization structure, there are going to be different responsibility centers. In some companies, you will make a manager responsible for the cost, you will make a person responsible for the revenues, you will make a person responsible for the profits, you will make a person responsible for the investments. Once responsibility centers came into picture, there is a need to assess the performance of the person, because what will happen is, based on the responsibility center, you will tell that you will have to take care of the quality of the product. Now I need to measure the quality of the product using certain performance measure, and if the performance is good, there will be a reward. If the performance is bad, there will be a penalty. One way of doing this was your standard costing statement. That we used to prepare a standard costing reconciliation statement, calculate different variances. These variances are basically used to measure the performance of different people. Material price variance is used to assess the performance of the purchase manager. Material usage variance for the production manager, labor rate variance for the manpower manager, labor efficiency for the production manager. So we have different ways of assessing the performance of a person. Bharadwaj Institute may assess my performance based on one, the feedback which you give, second, the pass rates which are coming out of this institute. So they may want to assess the performance of mine. So every organization want to assess the performance. This assessment can be based on financial factors, can be based on non-financial factors. For financial factors, you have three ways of assessing the performance. One is called return on investment, ROI, second is called residual income, and third is called economic value added, ROI, RI and EVA basis. Under non-financial measures, you have multiple methods like balance scorecard. There is something called as balance scorecard. Unless you know what is balance scorecard, you will not be able to attempt the case study on a balance scorecard. There is something called as building block model, performance pyramid model, performance prism model, triple bottom line approach. So you will have to understand these approaches and then evaluate a case study and do a building block analysis of one company, do a balance scorecard analysis of one company, do a performance pyramid analysis of one company, do a performance prism analysis of a company. So that something like that needs to be done, which is on your non-financial measures of performance. After that, we go to an area called as not for profit sector. Till now our analysis was only for profit sector. Then you will have to do for not for profit sector. Not for profit sector is those organizations which are not required to make money or which do not operate with the purpose of making money. But still, what will happen is, when you are donating to an NGO, when you are donating money to an NGO, as a donor you would want certain satisfaction that this money has been used for the required purpose. So there is a framework to assess the performance of a not for profit sector company. In an exam situation, unfortunately this not for profit sector has been tested twice or thrice in exam. This is a very small area, but this has been tested multiple times in exam. This is a broad overview of the chapter. First we will learn about different organization structure. Second, we will understand about decentralization which will happen. Based on decentralization, there is going to be responsibility centers which are going to come in. Moment responsibility centers come in, I need certain measures to analyze their performance. There are financial measures, there are non-financial measures. Bharadwaj Institute may analyze my performance through the overall revenues I bring to Bharadwaj Institute, overall profits which I bring to Bharadwaj Institute. These are financial measures. But financial measures alone will not help, because this batch is doing well. Many students have come in, but next batch the students are going to reduce. The reason is I have not done a good delivery in the current batch. Next batch the students will come down. So non-financial measures of performance are also needed. You need financial measures or not. I could have talked about this financial, non-financial in multiple places, but this is an area where you are going to discuss in dedicated mode about this area called as financial measures and non-financial measures of performance. So in financial measures you have ROI approach, RI approach and EVA approach. In practical world you can do anything else also. Return on investment, residual income and economic value added are the three approaches which is there as part of your material. Then in non-financial measures you have multiple ways like building block, performance pyramid, performance prism, triple bottom line. See, all of this may get tested in exam, and unfortunately if a question asks you on triple bottom line and you don't know the concept of triple bottom line, whatever stories you end up writing in exam, you will not get any marks. I have seen papers being corrected by ICI. There was one question on something called as three types of customer or the three types of your CRM tool which is there. There is a specific theory which is there. There is something called as operative CRM, analytical CRM and strategic CRM. The student ended up writing something related to CRM, but ICI awarded 0 marks. They want specific answer. You cannot keep giving general information. So if you don't know about balanced scorecard, there is no point in answering that case study because you will end up struggling. You will end up struggling answering the case study because nothing logical you will write. You will have to write something specific to the case study. Writing general information is not going to help from an exam point of view. And then finally you will see on the not for profit sector, how do you assess the performance. Okay, first is responsibility accounting. What is responsibility accounting? Is getting information about a performance of an individual, collecting, summarization and reporting of financial information. Not only financial information, it can be sometimes even non-financial information. You should make a person responsible for either cost, revenue, profits. Cost and revenue together is called profit. Cost, revenue and asset together is called investment. If you do only cost, it's called cost center. If you do only revenue, it's called revenue center. If you do cost and revenue, it's called profit center. Cost, revenue and asset is called investment center. So you can have different types of responsibility center, suitable when top management has delegated authority to make decision, and this is something which needs to be done. If let's assume some of your parents are businessmen, in that case what will happen is, if they have a small business, if they have a shop or a small business which they can manage on their own, then delegation may not be needed. But if you try to have multiple branches, multiple outlets are there, multiple divisions are there, you cannot operate by taking all decisions on your own. So you will have to delegate. When you delegate, what will happen is, the problem is I have delegated one branch to manager 2. Now this manager is not taking any interest in increasing the sales. He is not taking any interest in increasing the sales of that retail outlet. I am taking care of outlet 1, he is taking care of outlet 2. When I take care of outlet 1, I want to increase sales because I am the owner of the company. If sales increases, my profits increases, my benefits increase. The manager 2 is least interested. He runs the business. If customer comes, he gives the product. If customer does not come, he is not taking any extra interest. Even when a customer comes, he is not taking interest to do cross selling, to do upselling. You learnt about these two concepts called a cross selling and upselling. He is not trying to do any of them. And when I ask him, why are you not doing any of them, he is saying, I am not interested in doing any of them because anyway I am not going to be rewarded for this. I am not going to be extra rewarded, or I am not going to be penalized for this. So if I have to reward him or penalize him, I can bring in a performance structure where I will say you will be responsible for the revenues which you generate. If revenues are 10 lakh, no bonus. 10 lakh to 15 lakh, I will pay you 10% bonus. 15 lakh to 20 lakh, I will pay you 15% bonus. 20 lakh to 25. So I can bring in a structure like that so that he takes a personal interest and tries to increase the performance. You may not see this as part of your articleship exposure, but many companies will have something called as a variable pay structure. There will be a variable pay which will be there. This variable pay is dependent on your rating. Every company will give a rating for your performance. Your manager may give a rating, or there will be a structure by which a rating would be arrived at. Based on your rating, you will be paid a variable pay. Now why this variable pay was introduced was to incentivize the employee, because you would want the employees to have a better rating. How can they have a better rating? If they take care of the clients in a better manner, if they take care of the internal stakeholders in a better manner, if they are able to reduce cost. So all these if they do, they'll be paid a bonus. So that variable pay was brought in only because I wanted the employees to work in the best interest of the company. There are 4 types of organizational structure. Entrepreneurial organization structure is what extremely small businesses will do. The entrepreneur or the owner will take care of entire decision making. In this structure, the owner is expected to have knowledge of everything. Control or decision making revolves around the owner. From this, organization started moving to a functional organization structure. What is functional organization structure is? Company A can have production manager, can have sales manager, can have finance manager, can have operations manager, can have, so these guys are responsible for their own division. Production manager is responsible for the team which is reporting to him and ensuring that the production is there. Sales manager is responsible for the sale of the product, so he will have a team reporting to him. Finance manager has his own team. So different functions are there and there is a manager who is taking care of this. In this kind of structure also, you don't give too much independence. You don't give too much independence to the manager. Business is departmentalized on the basis of functions such as production, sales, marketing and finance, useful for small organization, less independence to make decision. Then came the third structure, which is called divisional organization structure. In divisional organization structure, what you end up doing is company A, example ITC Limited, you have hospitality division, which is the hotel division, FMCG division, which takes care of your FMCG products which they are selling. There is a tobacco division, there is a paper division, so multiple divisions they may do. Within a division, production manager, sales manager, finance manager, marketing manager. Within the FMCG division, again production, sales, finance, marketing, so you can keep dividing. These people will not have much of freedom. They will report to the manager of the hospitality division. He is called as the divisional head. The divisional head would be given lot of freedom. He will take care of the entire division and he is responsible for the division profits or losses. Under this kind of a structure, there is a lot of decentralization which will happen. Clear? Any doubts on this? This is called your divisional organization structure. One hospitality division you take, and if this is company A, this is called functional organization structure. This becomes a functional organization structure where you don't give too much freedom to people. Multiple divisions operate under broad corporate framework. Each division will have various function, decentralization of decision making. Now increasingly another structure is coming into picture which is called matrix organization structure. Now what is matrix organization structure? Company A, production manager, sales manager, finance manager, marketing manager. In this, person 1, person 2, person 1, person 2, person 1, person 2. There are 2 people in each of them, okay? 2 people, 10 people, whatever number of people. These 4 people are collaborating together. And they report to a project manager. Also they need to report to their respective production manager, sales manager, finance manager, marketing manager. Let's assume a audit comes. In this audit, there is a need for some person from the audit division, some person from the transaction advisory division, some person from the indirect tax team, some person from the direct tax team. You have to report to your own manager. That is one way of reporting. Second, you have to report to a audit manager or a person who is going to take care of this audit. So there will be dual reporting which needs to be done. Why this you do is you want to have collaboration among the various division. When you have collaboration among the various division, there is a possibility of R&D also coming to picture. So under this, cross functional teams are set up to reap benefits of decentralization, speedy decision and early resolution of problem. If this kind of structure is not there, then what will happen is, let's assume you have to take care of audit of one client. You are taking care of the audit, you are responsible for that. Now you have to reach out to the indirect tax manager. Then he will have to reach out to his individual person working under him. Then he will say that okay, I will now tell him to work on this audit and the work will be done. So by this way you will spend a lot of time. This is one example. The second example is a customer has an issue. Now this issue is because of the sales team. This issue is because of the sales team. Now one manager will take care of this customer. He can question the production person, he can question the sales person, he can question the finance person, he can question the delivery person, he can question anyone in the team. So when that happens, you will be able to provide a quick resolution to the customer. So this is a matrix structure. Cross functional teams will be set up. Cross functional is one person from production, one person from sales, one person from procurement, one person from R&D. They will join together. Next is the levels of decentralization. So this is what I was talking about. There can be a cost center, there can be a revenue center, there can be a profit center, there can be a investment center. Cost center is responsible only for the costs of the division. There will be question only on the cost of the respective division. How do you assess their performance? You assess their performance by comparing budgeted cost with actual cost or standard cost with actual cost. You can compare with budgeted with actual or standard with actual. Example, finance team. Finance team is considered as a cost center. They don't bring any revenues for the company. Revenue center is comparing budgeted revenue with the budgeted revenue with the actual revenue. You compare the budgeted revenue with the actual revenue of the division. Only the revenues, you are not bothered about the cost. Example, your sales team. There you are only taking care of the revenues part, you are not bothered about the cost angle. Profit center is budgeted profit with actual profit. Example, the divisional structure where I was saying different divisions are there. Different divisions are there. So there they have to take care of the revenue as well as the cost. And the last structure is here you will calculate ROI or RI or EVA. ROI, RI or EVA. And investment center means you are not only responsible for cost, profit, you are also responsible for making investments. You are given freedom to make investments. So the divisional structure which I was talking about, either the division can be a profit center or can be an investment center. Under profit center you give responsibility for cost and revenues. Under investment center, cost, revenues, purchase of asset or disposal of asset. So when you are given responsibility of asset also, basically here you have given responsibility of debit side of P&L. Here responsibility of credit side of P&L. Here responsibility of debit as well as credit side of P&L, and here P&L as well as balance sheet. You are given responsibility of P&L as well as balance sheet of the division. If you want, you can increase credit to your customer. If you want, you can reduce credit to your customer. If you want, you can buy a new asset. If you want, you can dispose of an asset. Some guidelines will be there. In a practical world, freedom will be given, but still there will be some constraints saying that if you want to do an investment more than 100 crores, you will have to take approval of the head office. 100, 200, 500, they can decide depending on the organization. So every organization will have a performance management system. What is the performance management system says is, first you decide what kind of organization structure you want to be in. You can be under an entrepreneurial organization structure, you can be under a functional organization structure, you can be under a divisional organization structure, you can be under a matrix organizational structure. So you decide what type of an organizational structure you want to fit in. Determine the organizational structure and ensure that the structure must be appropriate and best fit. Moment you decide the organization structure, based on that you will decide how much freedom you want to give. Under an entrepreneurial organization structure, there is zero freedom. Technically there is zero freedom. Under a functional organization structure, the functional heads will have some freedom. They will have some freedom. Divisional organization structure, the freedom increases. Evaluate the degree of delegation of control and identify the responsibility center. If I do a one-to-one mapping, divisional organization structure can be profit center or investment center. Functional organization structure can be cost center or revenue center. When it can be revenue center, sales team. Sales team can be a revenue center, the other divisions can be a cost center. Entrepreneurial organization structure, you don't give any freedom. A matrix organization structure depends. The matrix organization structure is a combination of two structures. It's a combination of It could be that there are multiple divisions in the company, then there are multiple sub functions, and then you club them together and form a matrix structure. So it depends what kind of a structure you want to do it. Most important part is when you bring in performance measure, these performance measure, one, should be relevant to the organization, and the second thing should be based on controllable factors. Suddenly Bharadwaj Institute says that we will evaluate your performance based on how many students are clearing the entire group of chartered accountancy. If they are going to tell me based on that, I somewhere will feel that I cannot be held responsible for the other subjects, because that's beyond my control. I cannot be held for the whether a student is clearing other subjects or not. What I can be held responsible is my subject. So if they want to evaluate my performance, they should evaluate my performance based on factors which are under my control and not for factors which are beyond my control. Second, the factor which you are selecting should be relevant. For example, if they want to select the number of students passing, I agree to that. That's a kind of a relevant factor which we are analyzing when we are doing when I want to analyze the effectiveness of our teaching. So if I want to analyze the effectiveness of our teaching, I want to check the pass rates of the student. That's technically a relevant factor. You will have to decide whether the factor which you are evaluating is relevant or not. Suddenly Bharadwaj Institute wants to check that after clearing chartered accountancy, percentage of students going for higher education. Now that's beyond my control, and that's not relevant also for the whether the student is passing or not passing is relevant. Whether students going for higher education or not is not relevant to check the effectiveness of our teaching. So establish the performance measure and the target for each measure. Review the performance with the help of KPI dashboard. KPI is key performance indicator, and take corrective action. An example of the performance dashboard is the reconciliation statement. The reconciliation statement which you prepared is basically an example of a performance dashboard. It's an example of a performance dashboard where you are comparing your standard cost with the actual cost, budgeted revenues with the actual revenues, budgeted profit with the actual profit, and then based on that you can take corrective actions if required, or change the budgets. Whatever different things could be done by the organization. There the analysis was only on the financial factors. Here they will have a factor called as percentage rejection. So what was the planned rejection? What is the actual rejection? Time taken to inspect a unit, this can be one of the factor. Percentage of on time delivery to the customer, this could be one of the factor. So there are multiple factors which I can take. Customer satisfaction score, customer delivery delivery rating. So you give the delivery of the product, what is the rating you get from your customer for the delivery of the product which are being done. Variety of products provided to the customer. So there are multiple things. Normally look at 4 types. Okay, this is learnt as part of balance scorecard. There is one, a financial angle. In non-financial you look at customer angle. That's one angle. Second is you look at something called as internal efficiency. Under internal efficiency you look at process side. Process side of an organization. Is the process working efficiently or not? So it's a combination of multiple things. I look at one, I look at financial. In financial I look at revenues, profitability, cash flows, return on investment. Then I look at customer, whether the customer is getting good quality product, is he getting it at an affordable price, is he happy with our services, am I providing after sales service. Then I want to check the process side, because if the processes are not good, I cannot meet the customer requirements, and if the processes are bad, even the employees will start cribbing about it. So the third angle you also look at from a process side, and the last you look at from a learning or growth side, where you take care of the employee side, So you consider all of this into picture, and accordingly you set your financial and non-financial targets. Okay, this is what I talked about. Characteristics of good performance measure. Good performance measures are those: one, it is based on controllable factors. Second, it should be relevant to the organization. Third, these should ensure that there is no conflict. When does a conflict arise? We learnt in transfer pricing. Division is saying he will sell 15,000 units. Company is saying sell 20,000 units. Now they are not agreeing to this. This will lead to unnecessary conflict. Provide incentive to make decision in the best interest of the company. If you are not making on the best interest of the company, then there is some problem. problem. If suddenly Bharadwaj Institute tells me that I am going to look at XYZ factor, and that XYZ factor if I have to achieve for my personal interest, and at the company level it may not matter. If the institute, if they in those questions, if they say we will evaluate your performance only based on the profits which you make, not any other factor, then obviously challenges will start coming in. So you will have to look at not only profits, you will have to look at multiple ways, maybe bring in dual rate transfer pricing system or two-part transfer pricing system if needed. Include factors only for which manager can be held accountable. Long term as well as short term. You can simply say short term means financial, long term means non-financial. Broadly this is the scenario. Long term are broadly non-financial factors, short term are broadly your financial factors. Many a times I don't want to report losses in the current quarter. I don't want to report losses in the current quarter, because of which what will happen, I will say that I don't want to I don't want to repair this machinery in the current year. I don't want to repair this machinery in the current quarter. If I repair this machinery, repairs and maintenance expenditure will go up and I will start reporting losses. So I will consider short term. So you will have to think about long term as well as short term measure. We learnt about in an area called as total productive maintenance, TPM, overall equipment effectiveness, where we said I have to take care of the maintenance even if it means that you will have to temporarily stop the manufacturing. You will have to do preventive maintenance and all. If you are not doing those maintenance activity, it will unnecessarily lead to challenges. So you will have to consider both long term as well as short term measure. ROI, RI, EVA are the financial measure. Balance scorecard, performance pyramid, building block, performance prism and triple bottom line are the non-financial measures. Okay, pros and cons of performance measures. What are the advantages and disadvantages of performance measure? Advantages, this will ensure, it provides me a guidance saying that what I need to achieve. If Bharadwaj Institute tells me that this is what I expect from you, at least I know what needs to be done. If they don't tell me what is expected from me, then I am kind of having no guidance as to what needs to be done. Standard costing provides that guidance. Standard costing provides that guidance to the employees as to what needs to be done. Develops agreed amount of activity, clarifies objective. The objective is to make profit of 25 lakhs. The objective is to have zero defect. The objective is to become a market leader. So unless those performance measures are there, if you don't have any, I have been telling this, I keep telling the students at inter level also keep telling that you need to have a target, you need to prepare a plan for your CA preparation. That is every day how many hours you are going to study, which subject you are going to study, how are you going to complete the preparation. At final level at this stage may not be that much relevant because of your articleship and other pressure, but still you need to have a plan in place as to how you are going to complete your preparation and do 3 revisions before your exam. That plan if you don't have, you are going to unnecessarily not achieve your objective. Moment you don't achieve your objective, indirectly the result which come can even turn out to be unfavorable. The results can turn out to be unfavorable. So plan is very much needed. If your audit partner or audit manager does not tell you that this audit needs to be completed in 10 days, you are least bothered. You go there, spend time, complete, come back, spend time, come back. You are not even trying to complete this audit in 10 days. Every time, this is what happens. Whenever my senior used to give me some work, the first thing I used to ask him is, by what time you want this to be completed? This is a natural question which people ask, because if you don't tell me the time, I don't have a guidance as to what needs to be done, and performance measure will provide you that guidance as to what needs to be done. Agrees amount of activity, clarifies objective, better process understanding, facilitates comparison. This is your reconciliation statement. Reconciliation statement. If I tell you to prepare a reconciliation statement of your plan with actual, whether you are going right in your preparation, you will not have an answer, because 99% of the students don't prepare a plan. 99% of the students don't prepare a plan. You don't have a plan in place. I have a plan in place as to how do I want to complete my classes. So I keep comparing it with the actual performance. I have given you timeline of September 30. I am very comfortable to complete it earlier also, because this batch major cancellations did not happen. Normally some cancellation will keep happening. This batch only I think some 3-4 classes got cancelled. So I am very comfortable to even complete it by September 1st week or 2nd week. That's the time I can complete my classes. But I had a guidance saying that September 30 is the guidance. I added some buffer which is called budgetary slack. I did some buffer, and then I wanted to assess. So I am now able to facilitate comparison. I am able to, whether you see it or not, every time I complete a chapter, I see how much time did I take in the current batch, how much time did I take in the previous batch. This is to check whether I am going at a faster pace or at a slower pace. This comparison I keep doing it. As of now, when I did a check, we were broadly in line with the past batch. This current batch I am 5 hours faster. 5 hours faster as compared to the previous batch. This is a comparison I did with the previous batch just to understand whether I am going faster, slower. So I keep doing that. So that comparison can happen only if you have some plan, if you have some comparable number. Promotes accountability, target setting, include internal as well as external measure. The only thing is, when performance measures are not correctly set, in an organization, a lot of blame game will happen. Sometimes if they are not properly set, what will happen is your performance will not be optimum, because you will lead to suboptimal decision making, and it can also impact flexibility. I am not sure whether that is there in the answer, but it can impact flexibility. How does it impact flexibilities? If I tell you I want you to make every quarter profit, and suddenly there is a major maintenance needed, you said let's not do it, because you are not flexible. You say that you want to make profit every quarter, so you want to postpone this to the next quarter and then do it that time, but this will lead to unnecessary issue for the company. If the performance measures are not appropriately chosen and applied, need to balance multiple dimension of performance, you can add reduced flexibility also. Reduced flexibility and blame game can happen. Reduced flexibility and blame game can happen. You can go through this also. This is self-explanatory. Again, this is basically how you select your performance measure. What is the relevant performance measure? Point 234 is same. Okay, how is it same? Is internal is basically financial. External is basically non-financial. Multiple dimension of performance is internal, external, financial, non-financial, customer side, employee side. So you will have to take care of all dimensions of performance. Technically all the things are same. You can even say short term and long term. You need to take care of short term performance measure as well as long term performance measure. I will start with the first area, which is on return on investment, ROI. Whatever I am going to do is technically something which you learn in SFM, or you would have learnt at CA Inter. This is not there in SFM, but you technically learn it at CA Inter. Let me first touch upon ROI analysis. Now ROI is equal to EBIT, listen for some time, there is nothing to note down, investment, EBIT by investment. This is the formula, ICI uses. In practical, this formula can be split into two. One is called pre-tax ROI, second is called post-tax ROI. Post-tax ROI means multiply with EBIT into 1 minus tax rate. Any problem you do, and rare scenario tax rates is also there. I have not seen problem with tax rates, but if at all tax rates is there, you answer two ROI. One is called pre-tax ROI and second is called post-tax ROI. Pre-tax ROI means EBIT divided by investment, and post-tax ROI is EBIT into 1 minus tax rate by investment. Now what is the logic of this formula? EBIT by investment. Investment means debt, equity, preference. Investment means capital employed. The other name for investment is capital employed. What do debt guys get is interest. What do equity guy get is dividend. What do preference guy get is preference dividend. I start with, let's assume EAES. Okay. If you remove equity dividend, it will become profit of, sorry, if you remove preference dividend, if you remove equity, there is a retained earnings. Retained earnings, if you go back, equity dividend is added back, you get EAES. Preference dividend is added back, you get profit after tax. From profit after tax, if you remove tax, you go back to PBT, and if you remove interest, you go back to EBIT. So EBIT in short, if taxes are not there, EBIT in short, if taxes are not there, EBIT is technically equal to interest plus preference dividend plus whatever equity guys will get. I will not call it as equity dividend, residual money goes to them, So EBIT is technically equal to interest plus preference dividend plus whatever goes to equity, guys, provided tax is not there. If tax is there, that's why I said EBIT into 1 minus tax rate is the formula. Denominator will be investment, which is debt plus equity plus preference. Clear? Any doubts on this? There are two ways of calculating this investment. One way is there's a fixed asset, current assets, debt, equity, preference and current liability. You can add these three, or you can say fixed assets plus current assets minus current liability. Fixed assets plus current assets minus current liability. When you do this calculation, you will have to remove fictitious asset. What is fictitious asset? Is here some P&L debit balance can be sitting. P&L debit balance can be sitting at this side. So if that is there, because sometimes you will do total assets minus current liability, that's also fine. Total assets minus current liability, but in total assets don't add P&L debit balance. If there is a P&L debit balance, subtract it from the equity which is there. Subtract that number from the equity value which is there, because this is this is not a real asset, it's a fictitious asset. Few authors even consider intangible asset also as fictitious asset, which can also be deducted from the debt equity, which can be deducted from the equity value. But intangible assets sometimes can have a value also. Patents can have some value, but intangible assets also are adjusted. I used to work in a rating agency where they used to treat intangible asset as normally something which is written off from the net worth of the company. They were treating it more like a asset which has no worth, unless you can justify saying that intangible asset has a value. Normally we were writing it off against the net worth of the company. EBIT by investment, post tax ROI is EBIT into 1 minus tax rate by investment. EBIT or operating profit should be controllable in nature. What is controllable in nature is, you will see a profit statement of every division being prepared. Revenues less cost, you get EBIT. Less cost, you get EBIT, or let me call it this way: revenues less cost, EBIT before HO expenses. What is head office expenses is, there is individual divisions there and head office is controlling their operation. Head office will keep incurring some expenses. What they practically do is, this expenses divided to the split to the various divisions. So they will say less HO expenses and call it as EBIT. In most of the question it will not be called as EBIT, they will give EBT itself. Profit before HO expense and profit after HO expense. Now in this scenario, when you calculate ROI, you should not consider this. You should consider this, because head office expense, what they distribute is not in my control. I am under no control, because these guys unnecessarily spend more or spend less, unless some relevant expenses there, some expense which are specific to my branch, that you can consider in the cost itself. But if something which is distributed, technically I should not be held responsible, because suddenly you increase this apportionment, my ROI goes down, my bonus goes down. I cannot agree to this. Should be controllable in nature. This should mean that EBIT should be before head office expenses. Capital employed, debt plus equity plus preference, fixed assets plus current assets minus current liability. In a practical world, there is one more challenge on capital employed. The term capital employed means long term money, but many authors even consider short term debt as part of capital employed. Short term debt as part of capital employed. I don't see that challenge coming from a problem solving point of view. Basically what is capital employed is money required for running the operations of the company. If you have a trading company, in a trading company major fixed assets will not be there. They will have a lot of inventory, they will have a lot of debtors. This inventory and debtors will be funded with a bank overdraft, which will be called short term loan, which will be considered as short term loan. So these entities capital employed, if you calculate, will be very less. But technically the capital employed is not only your equity, debt and preference. You should also consider short term debt. The definition says long term money, but many authors even consider short term debt as part of capital employed. I just hope exam question doesn't have that challenge. If at all a challenge comes like that, then you can answer two answers saying that: one, considering short term debt as part of capital employed; second, considering short term, ignoring the short term debt part. Capital employed can also be opening, closing or average. Opening, closing or average. Compute all in the exam if problem is silent, and or write an assumption and compute one. Assume you have opening capital employed, closing capital employed, average capital employed. General rule is whenever you do a ratio, any ratio, the ratio is basically combination of two items. These two items can come from P&L. Example, net profit margin, net profit by sales. These two items can come from balance sheet, current assets by current liability. One item can come from P&L, one item can come from balance sheet. Example, ROI, EBIT is from P&L and capital employed is from balance sheet. General rule, which is what many organizations do. If one item comes from P&L and one item comes from balance sheet, the balance sheet item should be average. The balance sheet item should be average. Why is it to be average? Because balance sheet is as on date figure. Suddenly that example COVID came in, March 31 the figures can be something which is not the normal set of figures, because of the COVID suddenly accumulation of stock would have happened, accumulation of debtors could have happened. If you take average, at least the effect is lesser. When it comes to capital employed, what happens in capital employed is, few authors argue for opening capital employed also. Reason is, whatever money was there at the beginning of the year, using that money only I can earn profits. Using that money only I can earn profits. So I used the opening capital employed and earn profits throughout the year. If you use closing capital employed, unfortunately the closing capital employed will indirectly include the numerator. Numerator is your EBIT, will form part of your closing capital employed, not the entire EBIT. Whatever you retain as profits, whatever you retain as profits will become part of closing capital employed. And issue is, you are considering that part of the denominator, but I did not use that money to earn profits. So if problem is silent, you do ROI based on opening capital employed, ROI based on closing capital employed, ROI based on average capital employed. Most of the question they will not give you the 3 ROI, they will only give closing or opening, use that and complete it. But if the problem is silent and if you have time, do all the 3. If you want to do only one, I think ICA does closing capital employed, ICA does closing capital employed, but I would prefer you to do all the 3. It's not going to take much time. Again, it's not going to take much time. These I have said you have to do 2, but most of the question, 99% of the question I have not seen taxes being there. Taxes may not be there, so this headache will not be there. This headache will also not be there of the debt part which I was talking about, short term debt, long term debt, that also may not be there. The only thing which can be there is, there can be opening capital employed, closing capital employed, average capital employed. There alone please do all the 3. Now capital employed has one issue, I will explain that issue. Particulars before, after. EBIT, investment, ROI. Division 1 has a EBIT of 15 lakhs. Investment is 1 crore. Investment is 1 crore. Your ROI number is 15%. Okay. Company says if any investment earns more than 12%, you should do that expansion. Earns more than 12%, you should go ahead with that expansion. 12% is like the cost of capital. You do your NPV analysis. ROI is technically like IRR. It's technically like IRR. What return are you earning? So company said if you earn more than 12%, please do the expansion. I got a project, new project. This project will give you a profit of 1,40,000. Will give you a profit of 1,40,000. You need to spend 10 lakhs for this. Company is very happy. Company is very happy because this is a project which gives you 14% return. The company wants a return of only 12%. So company says please do this. Company says please go ahead and do this. The manager performance is assessed based on ROI. If you get anything more than 12% ROI, bonus will be paid. 13% bonus will be 10%. 14% bonus will be 20%. 15%, every 1% extra 10% bonus. That's what the management said. Now this manager was evaluating this project. He said 15 lakh plus another 1,40,000, 1 crore plus another 10 lakh, and my ROI drops to 14.91. ROI drops to 14.91. 15 lakh plus another 1,40,000, 1 crore plus another 10 lakh, and my ROI is dropping to 14.91. He is not ready to do this investment. He is not ready to do this investment. This is a conflict situation. Goal congruence is not happening. This is a conflict situation. Company says do the project. He is saying I am not ready to do the project because if I do this project, my ROI drops from 15 to 14.91 and you will reduce the bonus. You will reduce the bonus. So he is acting in the best interest of himself and not in the best interest of the company. Why company wants it to be done? Because absolute amount profit is good and that project on a standalone basis is giving a 14% return. What happens under ROI is company will say do a project which more than target ROI. Division will say I will do a project only if the ROI is more than my ROI. ROI is more than my ROI. Another example, 10 lakh. This project gives you a return of 1,10,000. Gives you a return of 1,10,000. This division is earning 10%. Company wants to earn 12. So already they are at suboptimal performance. New project gives 11% return. Company says don't do it. This guy says I will do it because my ROI improves from 10 to 10.09. My ROI improves from 10 to 10.09. I will do the project. Company says don't do the project. He is saying anyway my ROI is going up. So what is the problem? The company says I want you to earn 12% on any incremental investment. This investment is giving only 11% return. Ideally you should not do it. The manager is not ready to listen to this. So this is a problem with the ROI approach. Goal congruence issue. Divisional ROI can improve. Company ROI can decline and vice versa. So company will say do the project. Division will say I will not do the project. It can happen the other way around also. Clear? This is the problem with ROI. The opposite of this is RI. I will explain how RI is calculated. RI is equal to EBIT, which is your numerator, minus investment into cost of capital. RI is residual income. How much extra are you earning? Residual income. RI means residual income. How much extra are we earning? EBIT minus capital employed into the cost of capital. You wanted to earn 12%. You are earning extra 3 lakh. You are earning extra 3 lakh. So this is a extra money which is being earned. New project will give you extra 20,000. New project will give you extra 20,000. Company says please do it. Manager says I am also ready to do it because my RI from 3 lakh is going up to 3 lakh 20. My RI from 3 lakh is going up to 3 lakh 20,000. So he is ready to do the project. He is ready to do the project. So this RI will ensure conflict is not there. RI will ensure conflict is not there. In the other example, when this was 10 lakh and this was 1,10,000, company says this guy is currently earning 2 lakh, currently having a negative RI of 2 lakh. Company says don't do the project and he is also saying I will also not do the project because my RI from 2 lakh negative will become 2,10,000 negative. From 2 lakh RI will become 2,10,000 negative. Both same formula technically. The formula here is EBIT by investment. Here EBIT, investment will go as numerator, investment into cost of capital. Investment into cost of capital. ROI is called as a relative measure. RI is called as absolute measure. The problem with residual income approach is if you have to compare a company which is 500 crores within a company and another division which is 100 crores, both cannot be compared using RI approach. NPV, RI is like NPV. NPV is an absolute measure. If you have a bigger project, obviously your NPV will be on the higher side. If you have a small, if you do a 100 crore project and NPV is 2 crore and you do a 1 crore project and NPV is 1 crore, NPV approach will say 2 crore NPV is better than 1 crore. Whereas I am doing a 100 crore project and earning 2 crore and here I am doing a 1 crore project and earning 1 crore. So ROI is more like IRR. RI is more like NPV. RI is more like NPV. RI, the benefit is goal conflict will not be there. No goal congruence issue. Absolute measure, it will become difficult to compare the performance of a division with the other division of different size. That comparison problem will come. Clear? Any doubts on this? Good morning friends. Okay, let's continue with the discussion. In the previous session we were working on residual income as well as return on investment. We still have some more problems to be covered on that. But I'll first explain the next concept, which is economic value added, and then we go back to this area. Now EVA is pretty much similar to your residual income from a calculation point of view. EVA formula is NOPAT. NOPAT is net operating profit after tax minus cost of capital into capital employed. If you look at residual income, the formula was EBIT minus cost of capital into capital employed, or they use the word investment into cost of capital. NOPAT is loosely put, the formula is EBIT into 1 minus tax rate, because what is NOPAT is net operating profit. In operating profit you should not deduct non-operating item. One of the example of non-operating item is interest. Interest is a non-operating expenditure. So EVA is equal to NOPAT minus cost of capital into capital employed. It will technically match the residual income if you are using into 1 minus tax there, into 1 minus tax. But EVA has certain adjustments to be done. There are a lot of adjustments which EVA makes mandatory to be done. Because of those adjustments, what will happen is your EVA figure and residual figure, income figure, may not match. That's one point. And the number of adjustments which we make in EVA is trying to make that item closer to the cash flow which an organization gets. The objective is to make that number closer to the operating cash flow which an organization gets, and eliminate all non-recurring items, extraordinary items, something which is going to happen in only 1 year. All those items you kind of remove. Now in the adjustments, the first adjustment is for training and R&D, training expenditure and R&D expenditure. Training and R&D expenditure is considered to be an asset rather than an expenditure in this. So what happens is, if you have training and R&D expense in a problem, it will have to be reversed in your NOPAT calculation. When you do your NOPAT calculation, you will have to reverse this item. You will have to add back this item. It's there in the theory, you just understand it. It will be reversed in your calculation when you do your NOPAT computation. Also, when you do EVA calculation, we use opening capital employed. We use opening capital employed for adjustment. What is capital employed is your fixed assets plus current assets minus current liability, or debt plus equity plus preference. So if you have, let's assume 2021-22, I am doing the calculation for 2022 NOPAT computation or EVA computation. This was 15 lakhs, this is 20 lakhs, and this is training expenditure. This will be added to opening capital employed. The last year number will be added to the opening capital employed, because this adjusts your last year figure and it will adjust the last year closing capital employed. This figure will adjust current year NOPAT and current year closing capital employed. This does not matter to us because we are not going to use the closing capital employed. What we use is the opening capital employed. The logic is simple. Money which you have at the beginning of the year, you use that money and earn whatever profits or losses you want to earn for that year. So the formula basically says you will have to do NOPAT minus opening capital employed into WACC or cost of capital, whatever term you want to use. So first adjustment is on training R&D expenditure. These training are something where the benefit will come for more than a year. If there is some routine training provided by an organization where the benefit is immediate, those trainings will not be capitalized. Basically you are going to capitalize training expenditure and R&D expenditure. R&D expenditure capitalization, even your accounting standards may talk about certain options could be there, but this is even training expenditure, not even, I think even advertising. Okay, first let's look at the formula. NOPAT minus WACC into opening capital employed. EVA and RI are similar measure. However, EVA considers economic value of assets and will need certain adjustments. When you do your residual income, you take the figure as it is, you don't do any adjustment. Wherever you have this, I think you will have in your notes, you can write NOPAT is otherwise called as EBIT into 1 minus tax rate. If there are no adjustment, there can be a problem where there will be zero adjustment. If you have no adjustment, NOPAT is EBIT into 1 minus tax rate. NOPAT is EBIT into 1 minus tax rate, into 1 minus tax rate. In case I don't have other adjustments, which is there in the next slide. Next slide has the other adjustments, but if those adjustments are not, then a problem. NOPAT will technically be equal to EBIT into 1 minus tax rate. There are certain limitations of EVA. One of the limitations is it focuses on the historical data. Second, it's an absolute measure. So when it's an absolute measure, what happens is you cannot compare Reliance Industries Limited with Bharadwaj Institute if you want to compare it through EVA approach, because Reliance Industries will have a huge EVA because their capital base is on the higher side. Whereas if I want to compare Bharadwaj Institute and Reliance Industries Limited through an ROI measure, I can technically compare it because it's a relative measure. You compare two items, the capital with the EBIT which is being made. Advertising, R&D expense, staff training, non-cash items. Non-cash items are basically like you have something called as non-cash item excluding depreciation. Okay, I am not coming to the depreciation part. Certain times what will happen, an organization will create something called as provision for bad and doubtful debt. They will create this provision. You have created the provision, and in reality the expenditure has not happened. So that's like a non-cash item at that point of time. So those items you will add back to NOPAT, add back to closing capital employed. Closing capital employed, I am not bothered. I am not bothered about the closing capital employed, because most of the times you will do it on the basis of opening capital employed, unless the problem tells you to do it on closing capital employed. Previous years add back to opening capital employed. It will be like this also sometimes. They will give 2020, 19, 20 lakh, 10 lakh. All these three will be added to opening capital employed. All the three will be added to your opening capital employed. A part of it will also be written off in the P&L. A part of it, if the question gives you data, because you capitalize it, sometime you will have to write it off. You cannot keep it a permanent capitalized value. So it's not a permanent capitalized value. You will keep capitalizing the value given unless the question tells you otherwise. So advertising, R&D expenditure, staff training, non-cash items, all these needs to be removed from the P&L. When you remove it from the P&L, it technically gets added back to balance sheet. It will get added back to balance sheet, because what will happen indirectly is your profits will go up, equity value will go up on the liability side, some asset value will go up on the asset side. Staff training may be written as an asset, R&D expense may be written as an asset, provision for bad and doubtful debt, if you reverse it, debtors will go up. So something or the other will keep going up. This is the first adjustment. The second adjustment is on depreciation. Now what happens is your books of accounts do not allow you to value an asset based on its true economic value or based on its economic value. For example, if I own a land, the land I bought it some 20 years back or 30 years back, I bought it for 1 crore. In my books I can record this as only 1 crore as of now. Whereas what EVA says is go through economic value of asset. If that value is 50 crore, in capital employed consider 50 crore. Consider the value of that asset to be 50 crores in the capital employed computation. Now land doesn't have depreciation, but some other asset where the value can change based on the current economic trends or current economic value. Economic value is the real value of the asset. So there are two types of depreciation. One is called economic depreciation and second is called accounting depreciation. You can understand this like one is Companies Act depreciation, one is income tax depreciation. When you calculate your taxable income, you reverse your Companies Act depreciation and consider the income tax depreciation. Similarly, NOPAT computation, consider this, remove this. Accounting depreciation needs to be removed. So you will have to reverses add back accounting depreciation and deduct economic depreciation. Economic depreciation is based on the economic value of the assets. Consider the economic value of the assets. Not only this, this is current year. If you have this data for the previous 10 years or 5 years, whatever gap is there, add back all accounting depreciation to your opening capital employed and deduct all economic depreciation from your opening capital employed. For all past years, you will have to do this reversal. Many questions will give data for 1 or 2 years, they may not give for so many years, but technically what you do to whatever is the current year item will get reflected in NOPAT. Whatever is the previous year item will get reflected in an item called as opening capital employed. It will get reflected in opening capital employed. Add accounting depreciation, deduct economic depreciation. This will reflect in NOPAT as well as closing capital employed. I am really not bothered about the closing capital employed in most of the question. Previous year, add back cumulative is 5 years, 10 years, whatever data you have, and deduct cumulative economic depreciation to opening capital employed. Simple rule, past adjustments are made to opening capital employed, current year adjustments are made to NOPAT. Next item is income tax. Now what they say is, in your books of accounts, you have your deferred tax provision which may be created. So here what they say is, you please go by cash based taxation, don't go by your accrual based taxation. Under accrual based taxation, what happens is, you will have to charge two types of taxation. There is a current tax and there is a deferred tax which goes to your P&L. Here they are saying whatever is your actual tax liability, please show that as a deduction. Add back accrual based taxation and deduct cash based taxation. There is one more adjustment which will happen on this. I'll explain that in the problem, which is something related to interest. Something related to interest, I'll explain that adjustment later. This is what are the adjustments we need to make. If you are starting with profit after tax, then you may have to adjust an item called as EBIT, also interest also. If you are starting with EBIT, directly make these adjustments. If you are starting with EBIT, then there is no concept of adding back accrual based taxation, because in EBIT tax is not yet subtracted. You directly subtract the cash based taxation, proceed ahead. So these are the adjustments to be made. Now this is also one of the limitation of EVA. What happens is, because of these adjustments, there are, I think there is a book which talks about there can be even 100 adjustments which can be made on the EVA. So indirectly what will happen is, in EVA different people may make different assumptions and you may arrive at a different EVA number also. So it makes it a little complicated because of so many adjustments which are there.
Okay, sorry, let's continue now. So in the last session we had done something called as a financial measures of performance. Today I'm going to start with non-financial measures of performance. Under the non-financial measures of performance, you broadly have 5 areas. So let's just quickly note down or quickly discuss those areas. I'm not going to discuss in detail. First is balance scorecard. I'm going to touch upon each of this some time, or maybe some of them would be done in today's session, some of them could be done in the next session. So balance scorecard is one of the non-financial measures of performance. Second thing is, you have building block model. Third, you have something called as performance pyramid, performance prism, and another approach called as bottom line. In your material, what I would have done is, okay, in your material, what I would have done is, I would have classified the areas as the subparts of every chapter I do. So first area would have been financial measures of performance. Second area would have been non-financial measures of performance. The third area would have been balance scorecard. I would have kept balance scorecard as a separate area. Technically it's part of non-financial measures of performance. I'm discussing it as a separate segment because it carries more weightage among the available non-financial measures. But balance scorecard is also technically a non-financial measure of performance, so it's not something different. It is part of your non-financial measures only. Now why are we getting into non-financial measures of performance? Let's try to understand that. All of this, what happens in an organization is, the shareholder is not the only stakeholder of a company. There are shareholders in a company. Apart from shareholders, you have multiple other stakeholders in a company. Who are the other stakeholders in a company? Customer. Who else? Supplier. Okay. Who else? Government. Okay. Whatever comes to your mind. Government. Employees. Okay, so there are multiple stakeholders who are there. When you look at financial measure of performance, there's only one stakeholder whom you are bothered about, and that stakeholder is the shareholder of the company. Apart from that, I'm technically not bothered about the other stakeholders of the company. For me, those stakeholders would not really matter. When you looked at your ROI, RRI, REVA, nowhere customer came into picture, nowhere employees came into picture, nowhere government came into picture, nowhere society will come into picture. So there are other stakeholders, your lenders can be there, person who provide you loans and all. None of those people you are bothered about. Your ROI, RI, REVA is only for one stakeholder who is the shareholder of the company, or technically the owner of the company. So we are only bothered about one stakeholder. We are not bothered about the other key stakeholders who are there. Just give me a minute. I don't know, some issues there today. Okay, we were never bothered about the other stakeholders in the company. The other stakeholders are never an issue as far as your financial measures of performance is concerned. Our worry was with only one key stakeholder, which is the shareholder. This will not help us to sustain over a longer period of time. I need to take care of my customers. I need to take care of my employees. If I am not taking care of these stakeholder, I cannot sustain over a longer period of time. So your financial measures of performance are basically short term measures which cannot help an organization become sustainable. It's critical that an organization becomes sustainable. In fact, there are companies, for example, your oil marketing companies, you could learn about this in SFM as well. The oil marketing companies tell you that you will have to save fuel. They tell you that you will have to save fuel. They're indirectly telling you that please consume less of our product. Please consume less of our product. Because what happens if you consume this at a faster pace, there is a limit to the availability of this. So this may become non-available after some point of time. So they themselves will say that please use this at a, or try to conserve this. This is basically a demarketing campaign which is done by them. When you do a demarketing campaign, your sales will go down, but they wanted to be sustainable over a longer period of time, because if they run out of fuel, their business is stopped at that point of time. So their objective was not to only earn money. So here what happens is you have balance scorecard which focuses on shareholders, customers and employees. It will focus on shareholder, customer as well as employees, three key stakeholders. Building block is also going to focus on multiple stakeholders which are there. There is going to be some area which is related to employee side, something which could be related to your customer side, something which is related to your even your supplier side or lender side. Similar is with your performance pyramid, performance prism. Triple bottom line also talks about something called as environmental, social and economic bottom line. So each of this is basically saying that I don't want to focus only on one guy. I want to focus on multiple key stakeholders in a company. That's the broad area this is all about. Okay, let's now move to an area called as building block model. I'll first explain this model. Listen, in an exam scenario, if a question comes on building block or performance prism, performance pyramid, you will not be able to write anything unless you know the model. So that is why theory becomes very, very critical, because most of the time students are not even aware what is there in building block model and they are trying to answer a case study, which is obviously going to become difficult. Okay, now I'll first explain what is there in building block model. Now building block model basically tells what the standard costing said. What it said is every organization need to have standards. Standards are basically targets. Standards are basically targets which needs to be there. Based on the targets, there is also need for reward scheme to be in place. So one, it needs to have standards. The term we use is standard. Standard is basically targets needs to be there. The targets need to be given to the employees. If you are giving targets, also bring in a reward scheme. Also bring in a reward scheme. If you bring in a reward scheme and if you have good targets or if you have set good standards, two things will improve for the company. What will improve? Financial performance and competitive performance. These two areas will improve for the company. Your financial performance will improve. What is financial performances? Comparing your own performance. Competitive performances, comparing your performance with your competitor. Comparing your performance with the competitor. Why will financial performance and competitive performance improve? I have set a good target. I have a reward scheme. Because of this, the end result I'll have is good financial performance and good competitive performance. But why is it happening? This will happen because maybe quality improves. Quality of the product improves. Resource utilization improves. What is resource utilization? Is the employee productivity. The productivity of the employee goes through. Innovation improves. You bring in new things. You bring in new new possibilities in the company. So you think about what are the new ways of doing things and do some R&D measures, because of which you are now getting into doing some better way of doing the same thing. You bring in some flexibility in the company. Flexibility is ability to adapt to a suddenly something different happens in an industry. For example, take a hotel industry. In an hotel industry, one thing they need to always have is the flexibility part. What is the flexibility? During weekends there is going to be peak demand. How are they managing this peak demand is very critical. We saw one case study in Six Sigma problem. There what had happened is, when there was peak demand, that restaurant was messing up things. It was not able to manage the peak demand scenario. So do you have the flexibility to meet this peak demand? So there are results which are going to come, which is financial performance and competitive performance. Financial performance is GP margin, NP margin, ROI, RI, EVA. Just look at your balance sheet, look at your profit and loss, and then look at whatever ratios you want to consider. What is competitive performance? Is your comparison relation to the competitor. Now, how is this measured? They give one example, I'll give you. Success rate in converting an inquiry into an order. This is a measure of competitive performance. How is it a measure of competitive performances? An inquiry came to me. If it's getting converted into order, it means I'm performing better than my competitor. It means I am better than my competitor. Or certain ratios of mine can be compared with my competitors. Or how is my market share in relation to the competitor? So that can help me in understanding whether I'm performing better or weaker than the competitor. These two will happen. This is basically your dimension of performance. These results are based on 4 determinants: quality, flexibility, innovation, resource utilization. All technically focuses on one stakeholder, or all of this can happen with only one stakeholder, who is the employee, and finally the beneficiary can be the customer. The beneficiary can be the customer, but these has to happen through the employee side. So quality of a product, flexibility is responsiveness to the change, innovation, resource utilization. These 4 are the determinants of your performance. These 4. If quality improves, flexibility improves, innovation improves, resource utilization improves, automatically financial and competitive performance. That's the end result. That's the end result. Your product quality has improved, rejections have come down. There's a way to measure everything. So quality has improved. Flexibility, I have the ability to meet the unique needs. Innovation, I've been able to bring in new products, new services. Resource utilization, that is, what is the productivity per employee. For example, I can say that number of, for example, if you take an audit firm, the amount of time an employee spends on chargeable stuff and amount of time spends on non-chargeable things. Some of your time could be charged to your client, some of your time could not be charged to your client. So percentage of chargeable time, or the productivity of the, within a company, I can say number of units produced per hour is basically a measure of resource utilization. It's a measure of resource utilization. If all these 4 improves, technically your financial performance and competitive performance would be better. How can these four improve? These four can improve if you do this. These four can improve if you do this to the employees. Not only this, also this. Standard and reward. Standard is budgetary control chapter. Reward is doing the performance analysis based on standard costing and then finally giving them reward. So your standards, when you fix, it needs to have three characteristics. The standards need to have, you'll have to write these names only in exam. Equity, achievable, and ownership. Equity means equally challenging to all. Suddenly, if ICI says that the passing marks are going to be different for different category of students, it may demotivate some employees. Or suddenly there are 10 odd article assistants in an audit firm and they are saying that we are going to assess your performance through the customer satisfaction score. For 2 employees, you are saying if your satisfaction score is more than 5, you are performing well. For another employee, you are saying it has to be more than 7. For some employees, you are saying more than 8. That is not acceptable. It has to be equally challenging for all employees. You can differentiate for grade of employees. You may say that first year article assistant, I have a different target. Second year article assistant, I have different. Third year articles, I have different. Seniors, I have different. Directors, I have different. So that you can distinguish. But you cannot say that for the same set of people, if you try to do something different, it will not be okay. Second is achievable. Suddenly ICI says that the passing marks in each subject is 90 out of 100. People will not even try to clear this course. They'll move out of the course because it is not possible. It is not a realistic target. So if you are giving me a target, at least give me a realistic target. You tell me to this. We have talked about when I did effect of budget difficulty on performance. If you keep increasing budget difficulty, my performance will keep going up. But if you go beyond a level, I'll say let's give up. There's nothing which is possible because this budget difficulty I cannot achieve. So targets which I give should be somewhere, there should be realistic target. There should be a sense of achievability, that people should feel that it is achievable. If it's not achievable, then I can't do much about it because people will get demotivated. So there's a lot of linkages. So some of the areas of budgetary control I keep talking here. Ownership is technically following something called as participative budgeting process. Ownership means I should take your buy-in, saying that the employee should be okay with it. The employee should be okay with it to the extent possible. It's not possible for me to satisfy every employee, but wherever possible, I should ensure that the employee is okay with the given targets. The employee is okay with the given targets. If that happens, obviously motivation factor moves up. Motivation factors moves up. So the targets, the term is standard. In exam, please use the term standard, don't use the term target. Standards needs to have 3 characteristics: equity, achievable, and ownership. Equity means equally challenging for all. You cannot do differentiation. If you show favoritism, it will end up backfiring because employees will not be happy with this. There should be a sense of achievability, or at least the employee should feel that I can achieve this. If you cannot even give that confidence, that many a times it happens. In fact, it has happened with me also in my experience when I used to work in a rating agency, that when my senior used to give certain targets, sometimes I know that this guy is just giving for the sake of giving it, because somewhere I know that it's not achievable. When it's not achievable, I also don't put in effort. When things are not achievable, you're not going to put in any kind of efforts to try to get to it, because somewhere if it's achievable, you will try to take some steps towards it. And also the last part is, if you can follow participative budgeting process. Ownership means if employee is okay with it, he will start saying that okay, I want to achieve it. If you are able to get that buy-in from the employee, things will automatically happen. This is one part of the structure. This is one part of it. Just giving this alone will not help. After giving this, you should tell them that I am giving you all this with a reward scheme in place. The reward scheme also needs to have 3 characteristics. The reward scheme also needs to have 3 characteristics. One, it should act as a motivating factor. Now suddenly your audit firm says that you please do all these things, and if you do these things, I'll give you extra 5 days leave. Maybe it becomes a big motivating factor for some employees. 5 days leave becomes, or we will give you extra 1 month study leave. It can become a big motivating factor for some of the article assistant, because for them it's a critical factor. 1 month study leave. Maybe money may not play a big part at that point of time, but 1 month study leave can play a big part there. So something which should motivate employees. If it's not going to motivate, suddenly they say that you work really well over a period of 2.5 years, we'll give you extra 1 week study leave. Maybe it doesn't motivate and you're least bothered about it, saying that it's okay, 1 week is not going to make any big difference, why should I try to do so much for the 2.5 years? So article assisted may not be a clear example, because there are other factors which keeps motivating you, because there is some learning aspect which comes in. But I keep talking about that example because you can keep relating to it, because if I give a corporate example, some of them could not be relatable for you. So the reward scheme which I give in should motivate. Many a times in the place where I used to work, there used to be a monthly award which used to be there. The monthly award was 1,000 rupees per employee. Many employees were not motivated with that. It was not making big difference. But suddenly they said that there will be a mail which will come from the senior director. It will go to entire team in CRISIL. So more than the financial factor, the non-financial factor were playing a part. So it can be multiple things which can be there. It should be clearly communicated. Whatever reward scheme you are bringing in, you please communicate this to the employees. If you are not communicating it, it may not be something which the motivation factor is lost. If motivation factor is lost, performance will obviously be dropped down. This is already seen. Controllabilities, I should assess your performance based on controllable profit, not based on profit after head office expense. This is just an example. Similarly, I should look at factors which are in your control. As an article assistant, there are certain things in your control, there are certain things beyond your control. So let's ignore factors which are beyond your control. So, and a building block model basically talks about 3 areas. One, targets needs to be there, which is your budgets and budgetary control chapter. Reward scheme needs to be there, which is your standard costing chapter. Once this happens, 4 determinants will improve, which are all the 4 are non-financial. Okay, quality, flexibility, innovation, resource utilization. These 4 non-financial factors will lead to 2 financial factors or 1 financial factor. Financial performance will improve. Competitive performance can have an angle of financial angle also. It can have a financial angle also. It can have non-financial angle as well. So this is what building block model is all about. I think in one exam, a 20-mark case study came on building block. A 20-mark case study where you had to do the analysis of the company on the principles of building block model. You had to do these points. How you'll have to cover maybe 2-3 lines on equity, achievable ownership, 2-3 lines on financial performance and competitive performance, on quality, flexibility, innovation, resource utilization, taking the relevant points. There could be some calculation also to be done. You'll understand as we do it. Any doubts on what is building block? The objective of building block, again, indirectly, is to focus on employee. Your employee side focus is there. Employee side focus comes in through standards and reward scheme, and also the focus goes on to your customer and other areas. Customer focus comes through quality, innovation, flexibility. All these are customer side avenues. Finally, net your financial performance will improve and you may perform even better than your competitors. Clear? Any doubts on what is building block? I'll move to the second area, which is on something called as performance pyramid. I'll explain what does performance pyramid basically says. What performance pyramid is basically saying is, at a company level, there are going to be 4 levels. 4 levels of performance or 4 levels of hierarchy. At the overall company level, there is going to be vision or mission of an organization. You'll have your vision statement and mission statement as to what you want to do. Based on the corporate vision, you will keep moving down. Bring in certain objectives, goals, targets, what an organization needs to achieve. So at the top, you have your vision statement and mission statement. It focuses on 2 stakeholders. It focuses on mostly only 2 stakeholders, which is customer and shareholder. Its focus is not on the other stakeholder. Customer and shareholder is its focus area. So at the top, you have a corporate vision. Based on a vision, you will bring in strategic targets, strategic objective. The strategic objective could be on the market side or on the financial side. You see a shaded portion. The shaded portion is internal performance, and this is non-shaded portion is external performance or the external metric. The external metric and the internal metrics of performance. So you have certain market related targets. What could be market related targets? Anything related to the customer angle, anything related to the customer angle, and then you have something related to the financial angle. Market side, whether you are performing. So I have vision at the top. Based on vision, I'll have two strategic objective, one on the market side, second is on the financial side. For an organization to achieve something on the market side, you need customer satisfaction. You need customer satisfaction. This is technically called as CSF, critical success factor. Critical success factor. So your critical success factor will be on customer satisfaction. If customers are happy, indirectly your market side would be achieved. Whatever you wanted to achieve on the market side, it can get achieved if customer satisfaction is there. On the financial side, if you want success, the organization should work productively. Productively means efficiently. Efficiency is no wastage. Technically, you should not have any kind of wastage. So productivity and flexibility both are part of financial. Flexibility sometimes also help your market side. Because if you have flexibility, indirectly it can contribute to your market side success. So you have level 1 vision of an organization. At level 2, I have certain strategic objective, two broad categories, market and financial. For these two to be achieved, I have three critical success factor: customer satisfaction, flexibility and productivity. Customer satisfaction will be measured through these two: quality and delivery. Quality of the product. So these are called KPI. This stage is called KPI, key performance indicator. The above stage was called CSF, critical success factor. Above that was the objective of the company, and above that was the vision statement of the company. So quality and delivery. How quality is measured? Whatever you learnt in building block. The same KPIs can come here. Delivery is meeting the deadlines or whatever, providing customer multiple options of delivery, meeting the deadlines which you have given. Productivity can be measured through two things: cycle time and waste. What is cycle time? Is time taken from the receipt of the order to the delivery of the product. Time taken from the receipt of the order to the delivery of the product. This is called overall cycle time. This will be split into another item called as manufacturing cycle time. I could have talked about an item called as manufacturing cycle efficiency in one of the chapter. Anyway, we will discuss in detail about manufacturing cycle time in your strategic analysis of operating income chapter. But cycle time is basically the time taken from the receipt of the order to the delivery of the product. And waste is, you can measure waste in multiple ways: percentage of rejected items, scrap generated. So you calculate that. Objective is to minimize these two. Objective is to maximize quality and delivery. If these four are taken care of: quality, delivery, cycle time and waste. Quality, delivery will contribute to customer satisfaction. Cycle time and waste will contribute to productivity. Flexibility is more of a subjective area. Even when we were trying to do flexibility in building block, lot of times some subjective answers only we were writing. Most of the times you would have seen that I would have said that this is not the right metric, this is not the exact metric we need. So we were trying to take some metric which, for example, in a restaurant, the flexibility is ability to recruit staff quickly. Now many a times you may not have data to calculate this or a metric to measure this. Customer satisfaction will contribute to market success. Productivity will contribute to financial success, and both productivity will contribute to financial. Flexibility has a say on both. Flexibility primarily is on the financial side, but it has a say on both your market side as well as financial. In the end, if all these happens, quality and delivery happens, you will achieve external effectiveness. You will achieve external effectiveness, and if you are able to take care of this, you will achieve internal efficiency. Any idea what is effectiveness and efficiency difference? What is effectiveness? What is efficiency? Sorry? No, you will have to explain me in better ways. Maybe you could be right, but I'm still not understanding it. So what is effectiveness? What is efficiency? Something which is understandable. Okay. Okay, effectiveness is the work done or not. You prepare for your CA exam. Final result pass, you are effective in your preparation. If your final result is pass, you are effective in your preparation. Efficiency is the amount of time and cost you incur to clear chartered accountancy. So if you are taking more time to clear, maybe you are not efficient, but you are finally effective. Effectiveness is more critical than efficiency. Effectiveness is more critical. You will say that you are efficient, you spent optimum amount of time, you did your preparation only for 8 hours a day, you managed all things, you managed articleship, you learnt everything, but finally in exam you did not clear. Then it's not effectiveness. So effectiveness is more critical. Effectiveness is getting the desired result. Efficiency is getting it with limited inputs. I think I saw this example in some other not in your material, but in I think ACC or CIMA. They said effectiveness is clearing, efficiency is getting exactly 50 marks and 200 in your exam. Anything above that doesn't really add any value. So technically you may say that you have secured 55%, 60%, 65%, 70%, but net what your exam, what you want is 50 percentage marks. And when you go for an interview, they want to know whether you have cleared your chartered accountancy or not. Most of the times the marks do not play a part. You may write something in your CV. Maybe if you are having a rank, it may make a difference in your first interview, but beyond a point, it doesn't make any difference. So assume somebody does preparation for long hours and gets the scores 70 percentage marks, 60 percentage marks. Maybe you are effective, but you are not efficient. Technically, maybe it's not a very good example, but that's an example which was given in that, and that is true. Because beyond 50%, whatever you secure, it is not going to really play a big part. It's not going to play a big part. It may make small difference here and there, but 50 to 49 makes a difference. If you are scoring 200 vis-a-vis 199, that makes a big difference. But beyond that 200, those extra marks may not play a big part. So effectiveness is achieving the end result. Effectiveness is achieving the end result, whether you are getting the end result or not. As long as you are getting the end result, you should not be worried more. Once you have got the end result, you will then start thinking whether you are efficient in your operations or not. You are efficient but not effective, gone. Nothing much is going to happen. Effectiveness and efficiency is going to be discussed a little bit in detail in an area in the same chapter called as not for profit sector. You have something called as value for money framework. You'll understand this. There's something called as economy, efficiency, and effectiveness. It's not only efficiency and effectiveness. You'll also bring in an angle called as economy. What is efficiency? Is utilization of resources. Efficiency is how much time did you spend. Economy is how much cost did you spend. You're also spending some money to clear your chartered accountancy. So economy is finally clearing it at the lowest possible cost. Efficiency is clearing it with the lowest possible effort. Clearing it with the lowest possible effort. If you're able to make it, that is efficiency. Effectiveness is finally clearing it or not. So objective is on improving external effectiveness as well as having internal efficiency. Internal efficiency. See, your cycle time is good. There are no waste in your manufacturing process. Everything is good. But customer is not liking your product. Customer is not liking your product. You are efficient on the internal side. You are efficient. Cycle time and waste are technically measure of your internal efficiency. Cycle time and waste are measure of your internal efficiency. If your cycle time is expanding, you are not efficient. If your cycle time is expanding, you are not efficient. If waste is increasing, again you are not efficient. So that's one headache. But if you are able to do well on these two things and compromise on quality and delivery, then there is a problem. See, many times I'll keep saying that you'll have to balance two things. Here there's no balance and all. You will have to be externally effective. You will have to be effective on the external side. Obviously efficiency is also critical. It's just that I want to be effective, I cannot compromise on these things. Your focus is clearing chart accountancy, you are not bothered about anything else, that also is not going to work. You need to do articleship, you need to learn certain things there, certain skill sets will have to improve for you. All those is also very critical. Just clearing exam is not the only focus area you can have. So effectiveness is critical as well as efficiency, but effectiveness will be more important than efficiency. It will be more important than efficiency. This measure or this model focuses on two stakeholders only: your customer and shareholder. Customer through quality and delivery, shareholder through improved cycle time and lesser waste. If you have improved cycle time, lesser wastage, your costs would be on the lower side. If costs are on the lower side, your profits would improve. Any doubts on performance pyramid? Any doubts on the performance pyramid part? I'll move to the next area. There's another area in your non-financial measures still pending, which is an area called as performance prism. I'll talk about performance prism later. I'm going to talk on an area called as triple bottom line. This is not technically like a model. It's not technically like a performance measurement system. But it has certain points which will tell that an organization needs to focus on non-financial measure. It has certain pointers which is going to talk about something called as focus on non-financial measure. I've been talking about an item called as sustainability. Many places I would have said that we need to be sustainable, non-financial measures focus on sustainable. What is the sustainability all about? What does sustainability mean then? Should be a way to define sustainability. What do you mean by sustainability? Maintaining the revenue and cost. Maintaining the customer base. What else? Sorry? Achieving? Sir, mission? Okay, achieving vision and mission. Okay. What else? What else can be there? Resource utilization. Okay, I gave you an example where BPCL, HPCL all said that please reduce fuel consumption. If you reduce fuel consumption, I'm not sure whether any of them is coming there. So still, for them to be sustainable, they tell you to reduce fuel consumption. There's a demarketing campaign which they're doing. Why they are doing this demarketing campaign? To ensure that their product which they are selling is available. So sustainability is basically meeting the needs of the current generation, or current people without impacting the ability of the future generation to meet their needs. They should also meet their needs and you should also meet your needs. That's a technical definition. Sustainability is ensuring that you meet your needs. But when you meet your needs, please don't impact the ability of the future generation in meeting their needs. We are impacting it. Whatever damages you keep doing, we do a lot of damages. So there is definition to achieve sustainability. You are considered to be sustainable. If you can ensure three things. One is economic incentive. Economic is making profit. I don't have a problem with that. You will have to make profit. But along with making profit, you also need to take care of this. Take care of environment. Economic, environment, it doesn't end there. You also need to take care of social. Socialist, taking care of people who are there. So triple bottom line basically has three bottom lines. The term bottom line, any idea what does the term bottom line mean? Bottom line means what? Profit. See, basically there's something called as bottom line and top line. These are names which we use. We use the term top line when you prepare your income statement. When you prepare your profit and loss, not the account form, when you do it in statement form, the first line will be your sales. So that is called top line. The last line will be is the profit, which is called bottom line. Many a times organizations were focusing only on one bottom line, which is your profit. That will not work. You will have to focus on three bottom line, which is also called as 3Ps. You'll have to focus on people, planet, and profit. Profit is economic bottom line. Profit is economic bottom line. People is social bottom line. People is social bottom line. And planet is environmental bottom line. Planet is environmental bottom line. We need to take care of all the three: people, planet, and profit. If you are taking care of all the three, it's a sustainable project. It's a sustainable project. It's a sustainable company. So many a times, for example, paper manufacturing. If you do paper manufacturing, the raw material is going to technically come from wood. Wood is going to come from trees. So there could be a lot of cutting of trees which can happen. Many paper manufacturing company have a target of planting trees. So on one side some cutting of trees will happen, but they also have a target of planting trees. Reason is they want to have as minimal impact on the environment side. You put up a factory, let's assume in a remote village. When you put up a factory, obviously because of the factory, there are going to be some pollution impact can be there, some environment impact will be there. You try to cut that down to the extent possible. Also, surrounding people are impacted. When they get impacted, you also try to take care of them by doing certain CSR activities or by providing employment opportunities to the people around you. So you are not only focusing on making money. Just making money is not going to work. So nowadays we expect organizations to focus on three bottom line, which is your economic bottom line, also called as profit, environmental bottom line, also called as your planet, and social bottom line, which is also called as people. TBL is also known as 3P framework: planet and profit. Sustainable organization has to ensure social and environmental performance along with financial performance. Just making money alone is not sufficient. Just doing social and environmental also not sufficient. You'll have to take care of all the three. Environmental bottom line: planet measures impact on air, water, ground, waste emission, technically pollution related issues. Social bottom line: people measures corporate governance, health, safety, human rights, ethical behavior, taking care of your employees, taking care of the society. Economic bottom line: profit measures profitability. Just give me a minute. So this is what it is. If you do something and it takes care of social as well as environment as well as economy, then it is a sustainable decision. Then it's technically a sustainable decision which takes care of all the three. If you focus on social and economic, but profits are not there. Social and environment, but profits are not there. You are not making money, but you are able to take care of the people side, you are able to take care of the planet side. That is a bearable decision. You can manage for some time. There are a lot of organizations which don't make profits for some amount of time and then they start making money. So that's a bearable or something which you can manage. So if you are able to take care of social and environment, it's a bearable decision. If you are able to take care of social and profits, it's an equitable. Equitable is trying to take care of the people part. If you are able to take care of economic and environment, it's a financially viable decision, environmentally viable decision, but not something from the people side. Somewhere there could be an impact on the people side. This is what is there in this chart. If you look at, if you do take care of all the if you take care of all the three, it is sustainable. If you are taking care of planet and profit, if you're taking planet and people, if you're taking care of planet and people, most of the e-commerce companies at this point of time are in this area. They are in this area. They will start making money later. If you are not able to take care of planet, if you're not able to, not acceptable, not able to take care of planet, then it's an equitable thing. And if you're not able to take care of people, it's a viable thing, viable, financially viable, environmentally viable, but not making sense from a people side. A sustainable decision is one which can take care of all the three: people, planet, as well as profit. You will have to take care of all the three. Now coming to performance prism, if you look at the models which we have done till now, if I take triple bottom line as an approach, then it focuses on people, environment, and profit. Building block, if you take it as an example, it will focus on shareholders. To some extent, customers will also come into picture, and employees will also come into picture. That is what building block model focuses on from a stakeholder point of view. There are multiple stakeholders in a company. So from a stakeholder point of view, building block will focus on shareholders, to some extent customers, as well as employees, because you focus on quality, innovation, all that comes into picture. And you also want to enhance the skill set of your employees. So basically employees also come into picture. We also saw something called as performance prism. This was focusing on shareholders and customers, that's all, nothing beyond that. If you look at it, was only focusing on shareholders and customers. We were not bothered about the other stakeholders. We were saying that there is internal efficiency and external effectiveness. External effectiveness is for customer satisfaction, internal efficiency is for better productivity, and finally a better financial score. Balance scorecard is something you'll see it later. That also focuses on shareholders, customers, and employees. There is only one model which is performance pyramid. The performance prism. There's only one model which is your performance prism, which focuses on all stakeholders of the company. The stakeholder can be government, the stakeholder can be society, the stakeholder can be lender, the stakeholder can be anyone. There's only one model which focuses on all stakeholders of the company. We are only bothered about only few stakeholders. We look at all stakeholders of the company, and objective is to ensure that the requirements of all stakeholders is met. So under performance prism, what you do is, first you try to look at stakeholders satisfaction. That's the starting part. Stakeholder satisfaction. What is stakeholder satisfaction is, understand who are the stakeholders of the company and what do they want. Example, shareholders, they want return on investment, they want dividend, they want capital appreciation. Employees, they want good working condition, good career opportunities, good pay. Your lenders, they want prompt payment of interest and principal. Suppliers, they want regular orders from you and payment to be made. Customers, they want good quality, affordable price. So there are multiple stakeholders. So the first thing is, understand who are the stakeholders of the company and what do they want from the company. This model basically tells the stakeholders can be different in different places. We're going to see a problem where the one critical stakeholder is going to be contractual employee, not the regular employees. There are also contractual employees. So none of the model is going to be bothered about contractual employees of a company. So here there's one model which is going to even bother about the contractual employee. When I look at that case study, you'll understand. But basic thing is, understand who are the stakeholders. For Bharadwaj Institute, there are multiple stakeholders. So look at who are the stakeholders and what do they want from Bharadwaj Institute, or how we can meet their expectation. So that's the first starting part. Who are stakeholders and what do they need? What is their exact requirement? So different stakeholders. Now, once you have understood who are the stakeholders, you will have to develop strategies to meet these expectations. There will be multiple strategies which needs to be done. One strategy for meeting the expectation of employees, one strategy for customers, one strategy for shareholder, multiple strategy for shareholder. It can be anything, but I'll have to look at what strategies can help me in meeting what these shareholders want or what these stakeholders want. After the strategies are developed, you develop processes. You're basically going step by step. From strategies, look at what processes can be developed by the organization, because these processes are needed for the smooth functioning of the company and implementation of the strategy. Whatever strategy you are implementing, your strategy says you want to ensure that the employees are satisfied. So for that you develop a strategy saying that I will have a competent HR team, I'll bring in lot of training, I'll bring in maybe some amount of non-financial rewards, some amount of financial rewards, and then you develop a process to meet that. After processes, you also need certain capabilities. For the processes to work smooth, you need employees, you need systems. So capabilities needs to be developed by the organization. Once the capabilities are developed, so first is understanding what stakeholder want, what strategies can be used to meet these expectation. After the strategies are done, you need certain processes for smooth implementation of strategy, and for the processes to work well, you need certain capabilities. Capabilities is, you can technically call it as some infrastructure within the company, or some employees who are there in the company who will ensure that the processes can work smoothly. If processes work smoothly, automatically the strategies will get implemented. Now this is one model which also works on a principle called as, I give something to stakeholder, I also want something back from them. It's not that I'll only keep giving them and they don't give me back something. If I'm giving something to shareholders, like they want dividend and capital appreciation, when the company is in need of money, the shareholders should be willing to contribute. Maybe a rights issue would be made or a new issue would be made. I want, employees are saying that they want good condition, good pay, everything is fine. So when I am in need, I want employees to work in an efficient manner. I want them to do sometimes overtime if there is a need from a customer point of view. I want them to work in an efficient manner and understand whatever requirements of the company are met. Customers are saying that they want a good quality product, affordable price, and I understand. I would also want my customers to be loyal to me. So when I expect something from, when the stakeholders expect something from me, I also expect something in back from them. When the society says that you will have to do CSR activity, everything is done. When I am in some difficulty, I would want society to also reciprocate back. So I would want something back from them. So the last principle is stakeholder contribution. Stakeholder contribution. I cannot only keep giving to them, I also want something back from them. If you are saying that employees want XYZ thing, I have given them. After that, has the efficiency of the employees improved? Is the attrition rate come down? So I am giving everything, still the attrition continues to be high, or still the employees are not working efficiently, then what is the point of me trying to do all these things for them? They suddenly, shareholders wanted good dividends, good capital appreciation, I've given all of them. Now there is a big project which has come, I want some money from them. If they are not ready to give that money, what is the point of me paying dividends? I'll not pay the dividend, let me retain the money at the company end itself. Who are the stakeholders? What do they need? What strategies can help in stakeholder satisfaction? Processes needed to implement the strategy. Capabilities for operating and enhancing processes. Capabilities can be systems. You can build in some systems which are there. You can have a competent workforce which is there. What does the company need from stakeholder? What does the company need from stakeholder? I cannot only keep giving them, I also want something in return from them. If they cannot give something in return, then I also obviously cannot give, or I cannot meet their requirements. So I want something back from them. PP aims to meet the needs and requirements of all stakeholder. There was one exam case study which said that develop a performance management system, an alternative performance management system which can meet the expectation of all stakeholders. So the question had balanced scorecard or some other model was there, but they wanted a model which can meet all the expectation of all stakeholder. Unfortunately, many students ended up writing balanced scorecard as the answer, but the answer was on this model, which is your performance prism. Stakeholder management is critical and recognize the need to work with stakeholders to ensure that their needs are met. I will meet their needs, but I also want something back from them. If they are ready to give something back, then I am also ready to give it to them. This is also one model which links from your top level till the operational level, like your processes or the capabilities. your performance pyramid also starts from level 1, level 2, level 3, level 4, but it does not suggest anything on the process side. It does not say that at a process level you'll have to make this change or you will have to implement processes like this. This model starts from the strategy, goes on till the last level, which is your processes and capabilities. It also says that you may have to make certain changes to the process. I want employees to be happy. I want employees to be satisfied. I want no attrition in employees. The issue with this is my HR process was inefficient. My HR process was inefficient. These guys, when a recruitment was happening, they were not interacting with the employees. They were not updating them as to what is the update on their recruitment. When these people came into the company, there was no big onboarding done. They were not doing any induction. These employees are struggling. They are not knowing what to do whenever they face a challenge. They don't know whom to interact with. Certain system level issues are there, certain process level issues are there, and these guys are not aware because my HR team was not doing their work. The HR team was not doing their work, or the HR team did not tell the employees how their issues can be sorted out. An employee may have an issue, even a simple issue like that, their bank account is not linked for salary payment. Now these issues need to be sorted out by the HR team. If these issues are not sorted out, these guys will become unhappy, and final end effect of this unhappiness would be that they will leave the company. So the issue was of the HR team or the HR process. So I had to rectify that. I had to rectify the HR process. When I rectified the HR process, things automatically fall in place. Now I'll move to an area called as balance scorecard, which is also part of your non-financial measures discussion only. What balance scorecard says is, in a practical world, I've seen balance scorecard even in practical world. I'm going to focus on multiple set of segments. First segment is financial perspective. Bharadwaj Institute, financial perspective. I'm trying to prepare a balance scorecard of Bharadwaj Institute. Financial perspective, it has revenue growth 20%. This is the first target. This is their first target. You will have to bring in targets which can be measured. So they bring in a first target saying that revenue growth is 20%. Second target, they set profit margin of 30%. This is the second target which they have brought in. Two targets they give: revenue growth, profit margin. I can even add another target: EVA, RI, ROI. Any of the targets you can bring in. So that was one perspective they said. Second, they said customer perspective. Customer perspective. In customer perspective, the first thing I wanted to focus is customer satisfaction score of greater than 9. I'm going to measure a score for every student, and that score should be greater than 9. That is a review, that is a approach which I wanted to say. So customer satisfaction score of greater than 9 is my requirement. Second, repeat customers. When I say repeat customer, basically from CA inter to CA final and from foundation to inter, we want this to be greater than 60%. So these were the two targets I had. These are the two targets I had as far as the customer perspective is concerned. There's a financial perspective, there's a customer perspective. The third one is internal business or operating efficiency perspective. Internal business or operating efficiency perspective. Different names to it. Some case study you will see the term used as internal business. Some places you will see the term used as operating efficiency. For a manufacturing industry, for operating efficiency, we have an item called as manufacturing cycle efficiency. We normally measure it through that. Here what I wanted to do is average time taken to recruit new faculties should be less than 2 weeks. Whenever a requirement comes, I want that the recruitment should be completed within 2 weeks. That is going to assess whether my process, my HR process is working fine or not. This is one of the requirement I said I will measure. Next is your innovation / learning and growth. Innovation / learning or growth perspective. Innovation perspective mostly focuses on the employee angle. Mostly focuses on the employee angle. It could be other angles also which will come. So here, percentage of revenue from new course. I wanted a revenue of at least 25 percentage from new courses which I'm going to introduce. Second, training or skill enhancement for the faculties. The Bharadwaj Institute has said that we will spend at least 3% of our revenues on training or skill enhancement of our employees or the faculties. So this will ensure that they perform well. So what balance scorecard? This is practically mostly used one. This is what is mostly used by organization. The place where I used to work, they were following balance scorecard. The focus is not only on the financial measures, the focus is also on non-financial measures. Indirectly, you take care of shareholder here, customer here. These two are taken care in these two perspective. To a great extent, you take care of employees also, but certain places you still face challenge. Most of the model, the main focus is on shareholders and customers. There's only one model which talks about everyone, which is your performance prism. Balance scorecard. Balance scorecard considers both short-term and long-term goal, meets expectation of shareholders, customers, and employees. When you look at from a definition point of view, they have included employees also in the definition. We just saw one case study where there were problems with employees despite balance scorecard. There's one more question in the detailed case study. In the detailed case study, I'm not discuss that question now because that case study also has chapter 1 value chain and then this. So there will be always linkage. Multiple chapters will be linked there. So there also I think employee level issues were there with balance scorecard. So this has four perspective. Financial perspective. How do we look at shareholders? How do we look at shareholders? Provides financial targets and checks whether strategy is contributing to revenue and earnings. Objective is to increase revenues, objective is to increase profit margin, objective is to increase cash flows, objective is to increase ROI, RI, EVA, multiple things. Customer perspective, how do customers view us? Lead indicator, these are lag indicator because these are financial, which contribute to customer satisfaction and impact future success. On time delivery, on-site service, after sales support, defect per order, cost of product, free delivery, all these are the different things which I'll look at from a customer perspective. So financial perspective is there, customer perspective is there. Internal business perspective, you can just write another name for this, internal business / operating efficiency. Internal business / operating efficiency. Internal business / operating efficiency. This will be there in your initial theory. Objectives and processes which are necessary to achieve financial and customer objective. And last one is again innovation / learning and growth. Innovation / learning and growth. Innovation / learning and growth. Now, if you see this model and your performance prism has some amount of linkages. When I say linkages, that focuses on all stakeholders. This focuses on only 3 stakeholders. There you are saying that I want to link it to the strategy. From strategy, I want to go to processes. From processes, I want to go to capabilities. Directly link like that is not there. But still, process side, I'm not going to suggest any changes to the process, but some of the processes would be measured through this. The working of the process, the HR process, is it working fine or not? I may look at an internal perspective. And the capabilities part is learning and growth perspective. This is to develop future capabilities. This is more focuses on future part. Learning and growth is not focusing on the present. Learning and growth is focusing on the future. So you have a financial perspective where you want to improve profits, everything. That can be done if you take care of your customers. Financial part can be met if you take care of your customers. How do you take care of your customers? Through your internal perspective, which is your internal processes. Manufacturing cycle efficiency, delivery cycle time, manufacturing cycle time. I want to measure all of this, so I take care of my customers. How do you take care of the future aspect, because you want to be a sustainable company. That is through your learning and growth perspective or through your innovation perspective. Now, one headache with balanced scorecard is uh, there were earlier set of questions, at least in the old syllabus, the question used to give a scenario and say that classify this under either the financial perspective or the customer perspective or the internal business perspective or the learning and growth perspective. That classification was to be done. We have seen problems like this. Classification was to be done when we did a TBL, where we had to classify under people, planet, profit. We did a problem under cost of quality, where we had to classify under prevention, appraisal, internal failure and external failure. Now there's going to be a big problem as far as this approach is concerned, that how do you classify. I'll give you an example where you can classify under two approaches. Airline. In an airline industry, one of the critical factor which a customer would want is on-time performance of an airline. The airline, whatever timelines they have committed, whether the arrival has happened as per that time, the arrival has happened as per the departure and arrival, is it happening as per the agreed timeline or not. So they calculate this something called as on-time ranking. They calculate something called as on-time ranking or the on-time arrival of an airline. Now, on-time arrival of an airline can be a measure of internal perspective. Can be a measure of internal perspective. Why it is internal perspective is it is measuring the efficiency of your processes. It can also be measure of a customer perspective. It can also be a measure of customer perspective, because your customers would want the airline to operate on time. Next, same airline, cleanliness. You wanted to check whether it's clean or not. The cleanliness is again a measure of your process efficiency. Again, it can be a customer perspective. Again, it can be a customer perspective. Next, one of the case study, there's another example called as cross-selling of product. You want to do cross-selling of your product, or if you're in a big four, you want to do a cross-selling of your services. Now you can say it's a customer perspective because customer is getting one-stop solution. You can say it's a financial perspective because it's contributing to my revenues. It is adding up my revenues. You can also say that's an innovation perspective because you are trying to give your allied services to the customer, or maybe you are bringing some new product and giving it to the customer. So introduction of a new product is a learning and growth perspective because it's an innovation angle. It is also an internal process perspective because your internal processes were able to bring out a new product. It can be a customer perspective because you are taking care of your customer side, and it can be a financial perspective also because it adds up to your revenues. So many a times there will be a marginal gap, the line between this, whether it's an internal perspective, whether it's a financial perspective, whether it's a customer perspective, whether it's a learning and growth, that line of difference is very limited. The distinction is very limited. So sometimes what you will do is you will have to write an explanation if at all that classification type question come. Increasingly in your new syllabus, those classification type of question is not coming. They are telling you to prepare a balanced scorecard, maybe for a bank, for an education institute, for a manufacturing company, for an audit firm. You are required to prepare a balanced scorecard. So that issue may not be there. That classification level issues may not be there. But here, this chapter, this area alone has too much of issues on the classification part, because I will tell today the answer is customer perspective. The same question you ask me after 15 days, I'll suddenly say it's financial perspective. After 15 days, if you ask me, I'll tell you internal business perspective. So that classification level issues can come. Benefits of balanced scorecard is whatever is your benefits of your long term versus short term. I said financial versus non-financial. It will improve your long term performance. It will focus on non-financial measures. It will focus on your external measures. So that internal versus external, financial versus non-financial, leading versus lagging indicator, long term versus short term. Improves long term performance as BS gives equal importance to both financial and non-financial. Discourages short term focus as company has to take care of non-financial measure. Both are same point. You keep rephrasing the way you want. You are saying improves long term performance, then you are saying discourages short term. That's technically the same thing. You are writing it in different manner. Now balanced scorecard sometimes will fail. The major reason for its failure will be if the top management support is not there. If the top management support is not there for implementation of balanced scorecard. The place where I used to work, the balanced scorecard implementation responsibility was of the managing director. So you had to give that responsibility to the highest level person. If you are going to tell, because that person will have an overall overview of all the 4 things, your financial, what you need, customer, what do they need, which processes are to be improved. So if you give it to a mid-level person, he will just only his level of thinking, or he is going to think only about his processes, he's going to think only about his customers. He may not be even aware of what is happening on the financial side, how much profits the company is making, how much revenues is making. Senior management delegate implementation responsibility. Senior management delegate implement responsibility. If you do this delegation, there is going to be a failure. Also, each of the models which we have seen till now, performance pyramid, performance prism, balance scorecard, TBL, all this needs to be customized for your company. Sometimes what people do is, you will take the best company and copy what they are doing. You will take the best company and end up copying whatever they are doing. If you end up copying whatever they are doing, it's again going to fail. And some people also have a notion that balance scorecard is not a tool to make changes to improve performance. It is just a reporting tool. Reporting tool means at the end of every month or at the end of every quarter, whatever 10 things you wanted to track, those 10 things you will just give the actual data. So you will use it only for the reporting purpose. You will use it only for the reporting purpose. Again, it's going to fail. Sure. Before I come to benchmarking, I'll just quickly cover the small area which is still pending. I could have discussed this even with non-financial measures, which is linking critical success factor with KPI. When we did balance scorecard, you would have seen that for every perspective, sometimes we added an objective column and then did the key performance indicator. Some question we had a perspective and directly we did key performance indicator. So the CSF is basically the objective which the organization has. CSF is technically the objective which the organization has, and KPI is basically something which is measurable. For example, an organization has a critical success factor called as customer satisfaction. This is my critical success factor. So at the top you have your vision or mission of an organization, which is your level 1. Based on this, organizations bring in objectives, are technically strategic objectives. You bring in strategic objectives, and some of these objectives would be measured through some of the critical success factor. When we did performance pyramid, you saw a level 1 which was the corporate vision, then you had level 2 which is marketing success and financial success, and we had 3 critical success factor in that question. Customers are in that approach: customer satisfaction, flexibility and productivity, and these were measured through 4 operational measures. Now customer satisfaction can be measured through 1, number of complaints; second, customer satisfaction score or a rating; third, number of referrals given by the customer; 4, percentage of repeat customer. So your CSF can have 1 KPI, sometimes it can have more than 1 KPI also. Basically, how do you measure? If Bharadwaj Institute wants to measure student satisfaction rates, we can measure it through multiple ways. 1, we get review feedback from you, so student satisfaction rating or student rating. Second, percentage of repeat customers, that is from one level how many students are converting to the next level with Bharadwaj Institute, so that is the percentage of repeat customer or percentage of repeat students. So that's another driver I can have. 3, number of student complaints, that could be another driver which we have. So for one critical success factor you can have multiple KPIs. Another critical success factor is to become the market leader in the company, in the industry. To become the market leader in the industry, I can measure through 1, market share. How much is my market share as compared to other? 2, revenue growth, and I'll compare this revenue growth with the industry growth to check whether my to check whether I'm growing or not. So there can be multiple drivers by which you can, or there can be multiple factors by which you can measure your performance on the CSF side. The only thing is the KPI which you decide should be smart. That is another thing which they say. KPI which you decide should be smart. Smart is S stands for specific, M stands for I think measurable, R is relevant, T is time bound, A is achievable. So your objective or the targets which organization bring in should be smart targets so that there is a measurability there, there is an achievability there, there is a time bound kind of a targets which are there. CSF represent objectives that businesses are trying to achieve. They are derived from the strategic goals of the organization. When I decide my strategic goals, I need to keep in mind industry structure, competition, environment factor, temporary influences. Consider all these factors and then decide the CSF. During COVID times, my strategy could have been slightly different. So that was a temporary influence at that point of time. The industry structure is basically your Porter's 5 forces model. They decide how much competitive the industry is. Obviously, competition. Environmental factors is not only environmental, you also need to consider social factors also, because we also follow something called as triple bottom line approach. Under triple bottom line approach, I take care of the society as well as the environment. KPIs are derived from CSF. They are measurable. They are measurable. Each CSF can have one or more KPI. You can have one KPI or you can have more KPI. I want to generate healthy returns for my shareholder. Now this can be measured through one, percentage revenue growth, second, net profit margin, third, return on capital employed, fourth, ROI, fifth, EVA. So you can have multiple measures to check whether your CSF is getting achieved or not. The KPI target should be smart, specific, measurable, achievable, relevant and time bound. Smart targets are very critical, because if you have smart targets, there is clarity in this, because one, you are clear on what you want to achieve. Second, for example, if you say the one KPI target could be revenue growth of 25%, revenue growth of 25% in 2022. So time bound is there because you want to do in 2022. Specific, you are very clear as to you want a revenue growth. Measurable, it's easy to measure the revenue growth because last year revenue, current year revenue. Achievable and relevant depends on the context of the company. Is 25% achievable or not depends on the context. For example, during the COVID time, if you keep this target, then maybe it's not an achievable target. During the COVID time, growth of 25% may not be achievable. Even now also many industries 25% growth may not be achievable. So it depends whether it's achievable or not. And relevant is basically, is it a good driver in the industry or not? We did one case study, I think in balance scorecard, where what the organization was doing is they had two targets. The last problem we did, that overcrowding problem, where they said they wanted to focus on improving return on capital employed and increase in number of customers. These were the two targets they had. Now the problem with those two targets is their objective was wealth maximization for shareholder. Wealth maximization was a longer term objective. For that, if you have something called as return on capital employed, which is a short term measure, there's a conflict which is there. Every organization should implement KPI. See, KPI is very simple. What is implementation of KPI? Is implementation of standard costing technically. After standard costing, what you do? You measure your performance against the target, and based on your performance measurement, you either give a reward or you may penalize, and you may also decide to take some corrective action. If they are implemented in the right way is ensuring that you measure them on a consistent basis. Some KPIs may have to be measured every month, some KPIs could be every week, some KPIs could be every quarter, and some KPIs could be every year. So that is your linking CSF and KPI part. Now apart from this chapter has two more concepts. One is called benchmarking. Now let's first discuss on benchmarking. This concept of benchmarking in the earlier study material, in May 21 study material, used to be a bigger concept. They had covered something called as principles of benchmarking, types of benchmarking. All that ICI is removed and only the concept of benchmarking is there. Now any idea what is benchmarking? You could have come across this term at few places. What is benchmarking? Okay, setting some standards. Okay, you're right. What else? Balance. Okay, minimum level of performance I need. Anything else? You are right in the meaning of the term benchmark. You both have said right thing. Any idea what is benchmarking then? Whatever you have said is the minimum amount of performance which I need, or the targets which I need. That's technically called benchmark. What is benchmarking then? Okay, benchmarking is basically comparing our performance with someone else. The someone else could be internal to the organization, could be external to the organization, could be within the same industry, could be outside the industry, could be within the same country, could be outside the country also. Basically, you want to compare your performance with someone else. That someone else could ideally be the best in the best in the industry or best in the company. For example, in an audit firm, I have four divisions. There's an audit division, there's a tax division, there's a financial advisory division, and there's an internal audit division. Some of the processes, maybe there's something called as a planning process. In planning process, I get to know that the audit team is the best. They somehow ensure that their planning is superior, and somewhere their execution becomes better because of their planning. Now the financial due diligence team wanted to benchmark their planning process with the audit planning process. So they wanted to understand what we are doing, what they are doing, and how are they better than us. So understand that. Once you understand how they are better, you can incorporate those improvements in your performance. So benchmark definition is clear. Benchmark is basically something with which you can compare. Could be best in the industry, could be moderate in the industry. It's your wish. It's not that always you'll have to compare yourself with the best. For example, I may not want to compare my performance with Reliance Industries Limited. Maybe their certain processes could be very strong. Some of the processes maybe I want to even compare there also. I want to compare how is the customer okay, there is a call center which I have implemented. This call center is basically customers will call and ask certain queries and they need to be responded. Somewhere my team or my customers are not happy with this customer call center process. They are either worried about the longer waiting time. We did one question on Six Sigma on this. There was one question on Six Sigma which was talking about this. There could be longer waiting time, or maybe the response which these guys are giving is not good. Some challenges there. Now suddenly Bharti Airtel has decided that okay, there is some problem with our process. Let's benchmark our process with Reliance Jio, or let's benchmark our process with BSNL, or let's benchmark with something else in some other industry itself. Let's benchmark with ICICI Bank or Kotak Mahindra Bank, just to understand what is happening. Are the customers made to wait for a longer period? In fact, I had this experience with one of the bank, that whenever I call them, there used to be a longer waiting time. So they started giving an option to all their customer that moment I call, they say that there is going to be a waiting time of 8 minutes. If you want us to call back, please press a button. So once I press that button, they call us back after 10 minutes or 15 minutes. So I need not wait for in the queue for such a longer period. And also they call me back after that time. So I'm kind of happy with that, because it ensures that my waiting time is not there. Or if I really want to wait, maybe I'll wait for 8 minutes, because they've clearly told at the beginning itself saying that there's going to be a wait time of around 8 minutes. If you want to wait, you wait. So maybe these small things an organization may want to implement by looking at others' performance, by looking at what others are doing. Technique for continuous improvement in performance. Technique for continuous improvement in performance. The term continuous improvement can also be linked to an area called as Kaizen costing, but this is not totally Kaizen costing. Comparing the firm's product, service, processes with best performing organization. That customer call center is a process. If you compare that, that's a process level. You may want to compare the service delivery. One audit firm wanted to compare with another audit firm as to how they are delivering the service to the end customer. Or you want to compare at a product level. Objective is to find out how we can improve and ensure that improvements are implemented. Driving force to establish high performance and means to accomplish this goal. Objective is to improve your performance. Objective is to improve your performance. See, unless you benchmark your performance with others, you may not even know that certain things you are not good at. There are certain areas of improvement for you, and you somehow feel that okay, profits are there, revenues is growing, ROA is there, ROC is there, EVA is there, everything is good. So I'm not even bothered about understanding is there any area of improvement for me. Is there any area of improvement for me? That area for improvement you can identify only if you try to do something like this. Once you benchmark your performance, you will understand if at all there is area of improvement. Significant improvements in performance efficiency, cost savings, new revenue. So my objective is to improve efficiency. Maybe you can kind of remember these terms. It can target cycle time. Cycle time is basically the time taken from the receipt of the order to the delivery of the product to the end customer. That's called delivery cycle time. Or the time taken from the start of the manufacturing cycle to the end of the manufacturing cycle. That's called manufacturing cycle time. Productivity is number of units produced per hour or number of units produced per employee. Or for example, Bharadwaj Institute wants to measure productivity. Student teacher ratio is a measure of productivity. That will tell us that how many teachers we have to for the number of students Bharadwaj Institute has. Customer service and quality can kind of be interlinked, or it can help you in improving your or reducing your production cost. Any doubts on benchmarking concept? Let's proceed now. I'll move to the next segment, which is on not for profit sector. Let's move to not for profit sector. Okay, coming to not for profit sector, the bigger challenge with the not for profit sector company is that you will have to still assess the performance of not for profit sector company, but there should be ways to assess it. For example, the focus will not be to earn revenues, the focus will not be to earn profits. So if I don't have revenues, I don't have profits, I don't have ROI, I don't have ROC, all these metrics will not help in a not for profit sector. In your traditional set of companies, you have financial perspective as well as non-financial perspective, or financial measures and non-financial measure. Whatever non-financial measures were there, indirectly finally they had to contribute to financial measures of performance. We did one problem where customer satisfaction was continuously going up and the return on asset was not increasing. So somewhere there was a challenge in the company. They were saying that why ROI is not moving up when customer satisfaction is increasing. So somewhere the focus is clear that financial measures are very, very critical. Non-financial measures are also equally critical, but at the end they had to contribute to either an ROI or ROC or EVA for a company. Now, in a normal company like Bharadwaj Institute or any profit making organization, ROCE or ROI or EVA can technically consider everything. Your balance sheet, your asset side, liability side is considered in EVA computation. Your P&L is considered. So everything can get finally reflected in the EVA of the company. Now, first thing is not for profit sector companies are existing not for making money. Their objective is to meet some social objective. So it could be that some are focusing on enhancing education levels, some are focusing on ensuring security for people, some are focusing on providing it could be even providing food, it could be anything. So their objectives are entirely different. They are not there to make money. So does not exist for earning profits but for achieving certain social or charitable cause. It could be to provide education, it could be to even provide accommodation, could be to provide certain items like certain necessity like food, clothing. So it could be any of them. So the key characteristics for a not for profit sector company is the major thing is they are dependent on donors. They are dependent on donors, and when you are dependent on donors, for example, in the practical world, a major challenge is when you start earning, ideally, I always believe in this principle that a fixed amount of your income should go towards your charitable causes whenever you can afford it. It's not that at this stage you should start doing it, but whenever you believe that whatever income you are earning, a part of your income you should give it for charitable causes. When you try to give it for charitable causes, the major challenge is understanding whether that money is applied properly or not. There's always a fear that whether this money is being used for purpose, for whether this money is first of all used for the right application, or is there a fraud angle associated with. That's a major challenge which is always there with many people. So many a times if you want to donate money, you will not try to donate to an unknown person. You will say that if it's a genuine cause, if it's a known person, a person you get it to or a friend of yours is referring him. So in those scenarios you will do the donation. So the major challenge is there is a fiduciary relation towards contributor to ensure proper application. Fiduciary relationship or fiduciary responsibility. When you prepare a financial statement, the auditor gives a view on whether the financial is true and fair view. He finally comments on true and fair view. Similarly, as a donor, I want to know whether the money which I have given was done a true and fair application, for the purpose for which it was to be utilized. If I'm contributing to a school, I expect that that school uses that money and provides education to more students instead of using it for some useless purposes or trying to give extra salaries to their employee, or the trustee takes that money away. All those will not really help. So this performs non-economic activity. I think in December 21 exam, a 20-mark case study came. I think not-for-profit sector has been tested multiple times. In December 21, it was not even related to the case study. There were, I think, 5 subparts or 4 subparts. In that, 3 subparts were direct theory question. So one of the theory question was, I think, on key characteristic, where you had to mention what are the key characteristics of normally a not-for-profit sector. So they perform non-economic activity. When they perform non-economic activity, they may earn some revenues and all. There's a possibility of earning still some revenue, but that could be a loss-making proposition. Requires funds from members or external contributors to arrange resources. I need money from these people. When I take money from these people, I need to give them a reasonable assurance that there's a true and fair application. A reasonable assurance that there is a true and fair application. Like in the financial statements, you need a reasonable assurance that the financials reflect a true and fair view of the company's performance. Similarly, I also want to be sure on this part. So there is a fiduciary or a trust relationship with the contributors, and there's no distribution of surplus. Surplus is basically whatever profits they make, or there could be some excess of income over the expenditure which they will try to apply only for the charitable causes. They are not going to give it back to the either the donors or give it back to the members. There's nothing like that which is done. Because of these key characteristics, it becomes extremely difficult to measure the performance. The second, I think this was another direct theory question. What are the difficulties in measuring the performance of a not for charity or not for profit sector company? Example, a school. The objective of the school is to provide education to people in and around that place. Now the school has spent 20 lakh rupees. I want to check whether this was used for right purpose or not, or whether the benefit which the organization gets out of this 20 lakh is there or not. Becomes difficult, because it's difficult to quantify the benefits which you are getting. You are trying to provide education, so you spend 20 lakh rupees. Maybe there is increase in the number of students, but still whether that education is provided or not, whether the student is getting the benefit or not. So sometimes it is difficult to quantify the benefits which are coming in. Difficult to quantify the benefits which are arising out of a not for charitable sector company or not for profit sector company. So for example, in the same example of school, they say if you still want to measure, maybe you measure it through student pass rates, or you measure it through number of students completing education till 12th standard. So you took one person in the first standard, your objective would be to that he at least completes his higher education. So you try to ensure that he completes till 12th standard. That could be one measure of effectiveness, but still it becomes a challenge. It becomes a challenge to quantify the benefits. Second, many a times these guys are doing those activities which are the major responsibility of the government. Whatever activities these not-for-profit sector company are going to do, their major responsibility of that will lie with the government. They will try to play an allied role. They'll try to play an allied role. For example, education. Providing education is primary responsibility of the government. You have government schools and other things are there. So that is the primary responsibility. A not-for-profit sector can try to play an allied role. So their success or failure depends a lot on the government performance also. So for example, I am an institute which focuses on providing education. Now overall literacy rate going up depends on how government is performing as well. The government performance will also play a bigger part. So my performance, one, difficult to quantify cost or benefits. An organization is providing free education to poor student. The benefits derived by students cannot be quantified, but still you will have to measure, so they are saying you should try to balance the cost incurred and also measure them based on opportunity cost principle. What is opportunity cost principle? Is if you have not spent this 20 lakh for this purpose, if you had spent it for some other purpose, still again measuring can become very difficult. Could I have used it for some other purpose and got a better benefit? That's one way. Second, performance and commitment of government. Participates mostly in high public importance activity, food security, education and health activity. Primary role is of the government, hence achievement is dependent on government. You can't do anything with this, because your achievement of objective is dependent on how government is performing. Mostly you will be in this food security, education, health, so you can try to do something on these principles, but the major contributor is going to be on the government side. Third part is measuring the utility of the cost, or measuring the utility of the funds which is there. So one, quantifying the benefits is not there. Second is the related concept is measuring the utility of the funds. Many times what will happen is some of the not-for-profit sector companies will not have any inflow, zero inflows, only expenses will be there. They are there only to spend money, they are not going to have any kind of inflow. So here one way of measuring is comparing their actual expenditure with the budgeted expenditure. Comparing the actual expenditure with the budget. Some organizations spend out of budget and don't earn any revenue. Government will give you grants, and your objective is to keep spending them. You are into research and development, so you are trying to do R&D work. Government will keep giving you grant, you will have to do R&D, and once it's successful it goes back to the government side. So this is also something which an organization may end up doing. Multiple objectives. Sometimes there can be more objectives for an organization. It could be focusing on education, it could be focusing on allied areas related to education. So if you have multiple objectives, you'll have to prioritize your objective based on importance and urgency. So challenges in measuring performance can also be a direct theory question. It can be a direct theory question in a case study. You need to know the challenge and way to measure this. So one framework which is used to measure the performance is called VFM framework. VFM framework is value for money framework. VFM is value for money framework. Value for money framework focuses on 3 E's: efficiency, effectiveness and economy. Efficiency, effectiveness and economy. Somewhere I had told you that I'll talk about this item later on. I think we did one case study where somewhere effectiveness and efficiency was external effectiveness and internal efficiency. We were talking about this. Now effectiveness is basically meeting the end result. Effectiveness is meeting the end result. Efficiency is using lesser resources. Economy is lesser cost. Economy is at the lower cost. Economy basically focuses on lower cost. Example, I think this is there in one of the question also. School is an example. If you take effectiveness is percentage of students passing the exams, or percentage of students starting at LKG and ending it at 12th. Basically the dropout rates are opposite of the dropout rates. Dropout rate is people who are not completing education, and people who complete the education is opposite of the dropout rate. This is a measure of effectiveness. Efficiency is student teacher ratio. How many teachers you are employing for the students you have. Student teacher ratio is a measure of efficiency. Economy is basically amount of cost incurred per student. Cost incurred per student. So you will have to get into cost. Economy is more related to the cost side. Economy is more related to the cost side. Value for money framework can be used. Effectiveness, whether it has achieved the mission and objective, whether maximum output has been achieved with minimum input. Efficiency and economy is interrelated. Okay, efficiency is minimum input. For example, 1000 students are there, you are doing the work with 20 teachers. That is a measure of efficiency, but it may not be economical, because if you are paying very high to the teachers, it may not be economical, but it could be efficient. Another institute is doing 1000 students, but they're taking 30 teachers, and you are doing it 20 teachers, which means you are efficient. But you are paying to your teachers 40,000, they are paying only 20,000. So overall cost of salaries could be at a per student level higher for even 20 students. Whether the desired output has been achieved using the lowest cost. These were the original 3 measures of value for money framework. Like when we did 5 years, there was another 6th S added called as safety. They've added 2 more extras called as equity. Equity spent fairly, and ethics is spent properly. This is very, very critical. Ethics is very critical. What is spent fairly is you should not discriminate. You should not end up discriminating the end beneficiary on the basis of maybe gender, or on the basis of religion, or on some other basis. Any basis, there should not be any kind of discrimination. Whatever is your objective, go with that objective. In the objective itself, you are trying to cater only to a specific set of people. At least in that specific set of people, you should not have any kind of discrimination, and ethics is spending properly. Okay, for a balance, for a not-for-profit sector, there's also a adapted balance scorecard kind of a stuff. In a balance scorecard, what they are saying is, normally what are the 4 perspectives of balance scorecard? Can you tell me the 4 perspective? Financial, customer, internal business, operating efficiency, and this is an order. What adapted balance scorecard says is the same 4 perspective only, but the first perspective is customer, the second perspective is financial, because financial is not very critical. Customer is basically focusing on either your beneficiaries, the major beneficiaries which you have. The beneficiaries basically the students or the general public. So first is customer perspective, satisfaction of beneficiary and other stakeholder interests. Satisfaction of beneficiary and other stakeholder. This also become a direct theory question in that exam. They said prepare or give an adapted balance scorecard of this. They ended up giving the same answer. The measures were same: satisfaction of beneficiary and other key stakeholders. Financial perspective, fundraising, fund growth, and fund distribution. Internal business perspective or innovation perspective. Internal business perspective is your internal efficiency, volunteer development, and quality. And innovation and learning perspective is whatever changes are happening on the environment side, is the organization capable to adjust. During COVID times, many of the NGOs were able to cater to the requirement, because that time the requirements were on the higher side, and still despite the restrictions which were there, they were able to adapt to the changing environment, and they were able to cater to the society at large. So ability or capability to adjust to the changing environment. Any of them can become a direct theory question. Adapted balance scorecard has come in exam. So customer perspective, financial perspective, internal process, and innovation. In fact, I don't have that line. In fact, the theory also specifically says that you look at how we are changing the order of the perspective. Here the main focus is on the customer and not on the financial perspective. Customer is taking care of the beneficiaries and other stakeholders. Other stakeholder can be employees at best. It can be employees. Financial perspective is fundraising, fund growth, and fund distribution. Internal processes, measuring the internal efficiency. And your innovation and learning perspective is ability to adapt to the changing environment. These are other performance measures. These could be self-explanatory. Can you quickly just go through them? Quality of service. Attainment of objectives is basically a measure of effectiveness. Ability to raise funds to meet objectives efficiently. During COVID times, some of the NGOs were able to raise money faster also. At that time, people were contributing money as well. And some of them were able to raise money faster and were able to contribute to the cause. Transparent and periodical report to the stakeholder. This is very critical. I know a friend of mine who had done a donation of around, I think, some 30k or something to sponsor education of one child for one full year. To sponsor the education, he used to get periodical report on the child's progress. So they were sending periodical report every 3 months. The quarterly progress was given, the half yearly progress was given, the 9-month progress was given, the annual progress was given. And because basically how is doing in the education, that kid, how is he performing in the education, that progress reports were given on a continuous basis. Because of that, maybe it gives him that satisfaction and he's ready to even sponsor for 1 more year. Because when he got those reports, he was also very happy, saying that these reports are giving me an update on the progress which is happening. I give some funds. If I am finally updated as to how the funds have been utilized, at least it gives me some kind of satisfaction, saying that whatever funds I have given was used for the purpose. Because that's a main problem which you will face whenever you start donating. I believe that you should start donating at some point of time. Keep that as one of your objective at any point of time. Keep this as one of the objective. So whenever you start doing it, whatever is capable at your end, when you do it, you will start facing this challenge. You will start facing this challenge whether this is utilized for the purpose. Whatever, you will have to live with that challenge and still donate, or donate to a known person, whatever you want to do. But that's a challenge. So one of the way to tackle the challenge is this transparent and periodical report to the stakeholders. I think we're kind of done with this chapter. The last part talks about something called as performance report. I'll do case studies on not-for-profit sector in some time. The last part, let me just spend 2-3 minutes on this. Performance report is nothing but, we have already seen this at 2 places. One, in budgetary control, you saw something called as feedback reports. That feedback report is technically performance reports. In standard costing, you prepare a reconciliation statement. That is also a performance report. What performance report is going to tell us? What was the target? What did you achieve? And any commentary if they want to pass, extra commentary could be there. I'll also get feedback from the other person, add that feedback also in the commentary if needed. So performance report is basically going to highlight the performance as compared to the targets. It should be prepared on a periodical basis. The periodicity can be decided by the organization. It should try to incorporate the feedback from the other person. And also, for example, the managing director would want a report which gives the overall view of the company. He may also want to drill it down further if he wants to. So if he wants to analyze the performance of each of the manager, he can do it. Let's assume there is a production manager. He wants an update on his performance, not for people above him, but whoever is people below him, he wants a summary of their performance also. So it should flow from top to bottom. The top guy should know his performance as well as the people who are reporting to him. Responsibility accounting can be implemented only by issuing performance reports. Performance report should compare budgeted results with actual result, effect of activity changes and how these changes have been controlled by the management. Report should flow from bottom to top. Sorry, it should be top to bottom. Okay, it should be top to bottom. Manager should receive detailed update on his performance and summary of performance of other lower level managers. He should get an update of his performance as well as the lower level manager. Report should flow from top to bottom. You can just put that top to bottom.